Okay, so the next discussion is this: future price versus fair value. Fair value of futures. What is this? Now, on any day, there will be one spot price, and on the same day, there will be future price. For example, Indian context, spot price, let's say today, I'm just giving an example purpose. Let's say we are having 1st of November 2020. And we will have a future price expiring on today, but expiring on 30th November 2020. November future, it's called as November futures. And it will also have different, one more future price expiry on 31st December 2020. This is called as December futures. And one more future price applicable for expiry on 31st Jan 2021. That's called as Jan future. In India, we only have at present 3 contracts: current month future, next month future, subsequent month future. Only 3 months maximum. If you want to go to February, you have to wait for some more time. That's in present context. But exam problem can give you 6 months future also, 12 months future also. But as of now, we have only 3 contracts: current month, subsequent month, and next month. So 3 months, current, next, and subsequent, we are having 3 months expiry. So if you compare these two, these are all will be fluctuating daily basis. All these will fluctuate. All these change continuously, daily basis. Okay. Now, can you please tell me, what do you think is the difference between the future price and spot price? Both are traded today. Suppose spot price, for example, let's say this is 1000 rupees and this is, let's say, 1050 rupees. What is the difference between these two numbers? What is the application difference? Don't tell me 50 rupees difference. What is the difference representing? In the sense, when is 1000 applicable for? When is it 1050 applicable for? Spot price is, I'm not asking about the explanation, I'm asking about the spot price. For what transaction nature it's applicable? For future price, for what nature it's applicable? Spot price, if you want to buy when? Spot price for immediate purchase. Spot price for immediate purchase. If you want to buy it today, you will pay 1000 rupees. Now, future price is for what date? You are agreeing for 1050. For when are you going to purchase this share? Spot price is for immediate purchase. The future price in this example is going to be purchased. Is it today? It is going to be purchased. It is for purchase on 30th November 2020. In the sense, spot price and future price, everything is same. Only difference is the period of settlement. So spot price is for immediate settlement. The future price is for subsequent settlement depending on the expiry date. But this is for the same share, same company, same underlying asset. You understand underlying asset, right? For every future price, there has to be a base, that is which is being purchased and which is going to be sold. Therefore, the difference in spot price and difference in future price, the difference between spot price, future price is only because of differential settlement time. One is settled today, one is going to be settled later. Apart from this time of settlement, everything else is same. So what does the difference should ideally represent? Ideally should represent in time value of money, which is interest. So difference between spot price and future price, underlying asset is same, the company will be same, financial instrument is same. The difference is with respect to the timing of settlement. Therefore, the difference in timing, which is time value of money, should be reflected in difference between spot price and future price. So let's just write down that quick difference. You can write down spot price and future price. Both the prices are for same underlying assets, for same financial assets, or same asset, let's say, for same asset, that is within brackets you can say underlying, except the difference in timing of settlement. Except the difference in timing of settlement. Spot price for immediate settlements, and future price is for subsequent period settlement at a later date, subsequent settlement. Hence, the difference between spot price and future price should reflect time value of money. Difference between spot price and future price should reflect time value of money. Theoretically, it should reflect. Okay, now spot price and spot market value, spot market price versus value of share. Okay, let's just write it in the next slide. Hope you have taken down this much. Okay, now let me just write price and value. Price and value. Price and value. Okay, let's come to the price and value. Now, spot price versus value per share. Now, spot price. How do you determine market price? How market price is determined? This is determined by market forces. Market forces. What do you mean by market price? Market forces means demand curve and supply curve. Demand and supply, correct. Value per share. How do we determine? Based on various valuation methods. We have based on valuation methods. We have learned intrinsic value, equilibrium price, using CAPM, P ratio method. We have a balance sheet enterprise value method, a sales to price ratio method, numerous valuation subjective. Valuation methods are there. Similarly, we have future price and we have future value. future value. This is determined by market forces. Same, demand supply. Now, future value can be calculated. Now, future value it can be calculated. Again, we don't go to valuation method. When you come to value per share, valuation method is already considered. We take the help of spot price. Because we know what should be the future value. The difference should ideally represent time value of money. So, calculated by this formula, future value equals spot price plus time value of money. Time value of money. That is spot price adjusted for time value. And when no information is given, in general, what we assume? If no information, if nothing is specified in the problem, if no information is given in the problem, we normally assume price equals value. That is our regular interpretation, regular assumption. Value per share, intrinsic value, you can call different names. You say value per share, intrinsic value, theoretical minimum price, equilibrium price. We have discussed earlier. Based on dividends, we can calculate. Based on book value, you can calculate. Value per share, number only is not same. How can name be same? Different people call differently. You can say intrinsic value, that's what you like. You can say P0, you can say V0, you can say theoretical price, equilibrium price, fair value per share, whatever you want, you can call it. There is no standard. That's what I told you at the beginning of this subject. We are understanding the terminology by the common sense, not by the specific names. This is not a legal law class. We don't associate ourselves with a particular word. But when we normally understand, price is determined by market, value for individual. That's what I meant with overall discussion here. Okay, so ultimately what we need to calculate is this. Future value is spot price plus time value of money. Then the question comes, what if future price and future value are not equal? If not equal, if future price is not equal to this, then what happens? Then we say there exists arbitrage opportunity. We will discuss all those things. If price and value are not equal, future price, future value is not equal, then there exists arbitrage opportunity. I'll explain all those things. I'll just give you the idea now. That's it. Okay. Again, this is called by different names. Let me give you. Some people call it as future value. Some people call it as fair value of future. Fair value of futures. Some people call it as the theoretical minimum price. Different names. Theoretical minimum price. Okay. Now let's go for calculation of that. Fair value of futures. Okay. I'll just repeat what I've discussed so far. Spot price is for today's settlement. Future price is for later settlement. So difference is only due to timing of settlement. So difference in the prices also should be due to the time value of money. In other words, future price, fair value, theoretical value of future price should be equal to spot price plus time value of money. Why theoretical name? Because this is theoretical calculation. No, we are supposed to be. Actual is always different. So we say theoretical price. That's what means fair value. Fair value means what is supposed to be. What is supposed to be means theoretical only. Theoretical only. That's why it is there. Okay. So theoretically, future price should be combination of spot price plus time value of money. Let's look at the movement of the future price and spot price. Let's try to focus on this. Assume spot price remains same. That means for theoretical discussion I'm having, assume spot price is flat. Spot price remains same. Spot price will not change. And future price will be at a higher date. It will be at a higher value today. Let's say spot price is 100, future price will be 102. Why it is higher? Because it is for later date settlement. So difference should be there, interest, time value of money. Now tell me, if spot price don't change, what should happen to future price, which is expiring at, let's say, month end? What should happen to this future price? It will reduce, it will remain same, or it will increase? Theoretically, tell me. Theoretically, other things remaining constant, spot price not change. Future price always higher than spot price? Theoretically, we just discussed. No, now. Spot price plus time value of money is future price. We just discussed now. Now, other things remaining constant. Future price will be increasing or decreasing? Okay. Please observe this. This is an interesting situation. Okay. Now, this 2 rupee representing, let's say today is 1st of November. Today is 1st of November and expiry date is 30th of November. And this 2 rupee represent time value for how many days? Please tell me. This 2 rupee represent time value for how many days? Spot price is 1st of November, for example, and expiry 30th November. So 2 rupee represents for 30 days. For 30 days. Now, let's say 10th of November comes. 10th of November comes. 2020. Spot price is 100 only, not changing. Now, tell me how many days should this represent? How many days the difference should represent now? When we started on 1st of November till 30th of November, we had a gap of 30 days. Now we are in 10th of November. So how many days? It should reflect. Earlier it was reflecting 20 days, 30 days. Earlier it was reflecting 30 days. Now it will reflect how many days? 10 days. Time value of money is not for the time passed, time remaining, right? When I started 1st of November, have I told 1 day? No. I told for remaining days till the end, remaining. So it is 20 days. That's a common mistake people do. Okay, now try to think and tell me what will happen to this number? What will happen to this number? Difference between future price and spot price. Will 2 rupee remain same or 2 rupee will change? Definitely it should change. Increase or decrease? I hope you're able to 10. The gap was for 30 days. Now the gap is 20 days. Therefore, it will reduce. Let's say it will become 0.5. Last day, what happens? Tell me. On expiry date, what is the time gap? So 30 days, 10 days, 10 days, then 9 days, then 8 days, 7 days, 6 days, 5 days, 4 days. Last date. What is going to be the time gap? 100 days. Suddenly. Okay, you're telling the price. I'm sorry. Okay, you're telling the price. Sorry. Okay, so the last day, it represents 0 time value because spot price and future price will be reflecting on the same date settlement. So as the time progress, the time value reduced because expiry date is fixed. Expiry date don't change. It will keep coming down on the expiry dates. The spot price and future price will converge. This is the movement of future price. Actually, I mean, this difference reflects time value of money. So as the time progress, the time value of money will come down. Okay, this is the actual movement of the price. But if the spot price changes, actually the graph will look like this. Please observe. Spot price will be below only. And as the time progress, please look at the gap. The gap was high. The gap reduced. The gap reduced. And ultimately it became same. So that is the movement of future price. If nothing is remaining, flat, but even then future price comes down. But in case of the market price fluctuating, future price also will fluctuate in tandem. That's why it's called as derivative. But it will also always be high. People expectations not play a role. No, that's what we are trying to discuss here. The future price should be just a derivative of spot price. You should not have any other reason. Theoretically, you should not have any other reason, because the difference will represent the time period only. Nothing else is different, right? Everything else is same between the spot price, future price. The difference is only due to the time of settlement. So only time value of money should be there. But again, what is time value of money? Different people have different values, right? For me, 1 month value will be different. For other person, the 1 month value will be different. But we have to pay as agreed, and difference will be settled daily. Please don't bring in difference will be settled daily here. Mark to market, that is only mode of operations. Ultimately, I told you, what you settle in physical settle delivery basis or net basis or MTM, all are same. So don't bring in the mode of operations here. We have to pay as per agreed. Yes, that is what the amount if you agreed today. But I'm not talking about what will be the price tomorrow. If tomorrow some person want to enter for a fresh contract, new price will come. After third day, one more person will come. He want to enter into contract. We are not talking about only one person point of view. We are discussing about on a every day how the future price will change. And once you agree today future price, you need another future price for square off. Don't forget that. You need always future price for a final settlement. Okay, today I enter into this price. I bought it. But on settlement, on expiry date, you need one more price for you to settle. Unless you are going to have one more future price, square off cannot happen. So don't worry about the settlement aspects here. Keep it very simple. The difference between spot price, future price theoretically should reflect only time value of money. Therefore, spot price is less, future price is high. And as the time progress, the gap between future and spot also reduces. And as the gap reduces, the value difference also will go down on the expiry date. The spot price is for immediate settlement. The future price is also for immediate settlement, because that day only is future. That day is future. So on the expiry date, on the last second, 3:30, because even then half a minute is there, 50 minutes there, small difference is there. But on 3:30, the spot price and the future price will become same, will converge on the last second. So if whatever the stock which will be expired at 3:30, all the futures will be at same spot price. Till then, small difference will be there, but premium will definitely reduce. The difference will definitely reduce as the time progress theoretically. Actually, small things can be different, because what is time value of money, what is the rate of interest, different people can have differently. That is why we are teaching you different strategies according to your level of time value of money, according to your level of rate of interest, according to your level of opportunity cost. That can differ from person to person. Okay, so we have to write down the examples, theory on these things and all to keep remember. Anyway, okay. So what we discussed about the things so far, let's quickly write it in the form of sentences. Then we'll go for formulas. So you can write few sentences now. Future price is mostly greater than spot price. Why? Due to time value of money. This why greater? Because of interest component, time value. Time value. Can it be lesser? There is a chance. I'll come to it later. Longer the expiry date, higher the future price. Like one expiry date can be December, one expiry date can be January. So January will have a longer expiry date, means longer time period, and longer time period means higher price. As the time value and the time period is high, longer the expiry date, higher the future price. Write down. Voice is breaking. Is it the same with others? Or is it due to their internet connection? Is it fine with others? It's clear, right? Okay. Maybe with the internet connection there. Okay, no problem. Okay. So longer the expiry date, higher the future price. As the time progress, expiry date don't change. Expiry date is fixed. So the difference between spot price and future price also reduce. Even if the spot price remains same, future price reduce because of time progress. Time progress. Time gap reduces because the expiry date is fixed. So even if the spot price remains same, future price reduces. On the expiry spot price, future price will coincide on expiry. On expiry date you can think, or on the expiry time last second you can think. The spot price, future price will become same because they will be for a immediate settlement, conceptually, theoretically. This time gap is like your examination. Like the way usually, how do you plan your exams? You'll be like examination, 80 days is there. Example, I'm telling. 40 days, 80 days are there. Let's say 40 chapters are there. Example, 80 days, 40 chapter. Okay, I'll do one chapter in 2 days. 80 will come. Very good. 40 days will get over. No improvement will happen. So 40 days, 40 chapter, no problem. One day, one chapter. You will revise your estimates. Then 20 days over, no improvement. Still you know how to manage. You will do, earlier I was doing one chapter 2 days. Now I'll do one day 2 chapter. Just reverse the ratio. 1:2 becomes 2:1. You know how to manage. Then 10 days, 40 chapters. Still you divide the day into 4 parts. One day 4 chapter you plan. You don't do, but you plan. 5 days over. Still you plan. One day you will do 8 chapters. You will have plans. 8 session a day you do. After getting up, before brush, after brush, before breakfast, after breakfast, before washing hands. You know how to do the division. Then 2 days over. Only 3 days left. Still 40 chapters remaining. Then you will be thinking, no problem. Next 6 months is there. Next exam I'll prepare. But that option is not there here. As the time progress, expiry date is there. And that is the expiry date. So you say 10 days, 9 days, 8 days, 7 days, 0 days. One day will come where the expiry date will be closed. Settlement has to happen. This is like telling Today's tomorrow will be tomorrow's today. Today you keep on telling tomorrow exam will come, tomorrow exam will come, tomorrow exam will come, and one day will come where you say today is the exam. So today's tomorrow is tomorrow's today. In a way, you can also maybe think slightly philosophical in nature, in the sense your spot price is like your present, your future price like your dream. So there will always be gap between your spot, your present, and your dream, your future. The difference represents interest in your subject. As the time progress, that interest also comes down. The time value also comes down because time remaining will come down. And one day will come where your future and your present will meet. You will always think, no, tomorrow I will die, tomorrow I will die, tomorrow I will die. There will be a point where today I will die. Means there will be a point when future meets present. You know what is it called as? When your future meets your present, that is called as expiry date. For a contract also, for a person also. That's why I always say, when you get the birthday, in my opinion, this is my personal opinion, people have a different opinion, I really don't see there is a reason to celebrate. As if birthday is your achievement. It comes every year, whether you like it or not. It is not of any of your success or your goals or target. Okay, I will get birthday next year. It will come. And more importantly, as a new birthday comes, keep it in mind, you are closer to your expiry date. When you are closer to expiry date, is it really a reason for celebration? You have to ask yourself and make a decision based on that. Okay, so enough of theory, enough of concepts, or enough of philosophical discussion. Things don't work too much. The two in CA classes, you'll always be thinking differently. Let's focus on the formula and while solving problems, what to be kept in mind. Okay, now focus on this one. Okay, what is fair value? Future price should be fair value of futures should be spot price plus interest, simple interest. Or if I use compounding, spot price into 1 plus r to the power of t. Or if you do continuous compounding, spot price into, remember the formula, into e to the power of r into t. You know r is rate of interest, t is time gap. T is always in years. Now, when should you apply which formula in exam? E you apply only when E value given in the problem, E value given, or when they specify continuous compounding. If E value not given in the problem, you really don't attempt this continuous compounding. E to the power of 1 plus RT, when they use the word compounded monthly, etc. When they use the word compounded monthly, compounded half yearly. So when they use the word compounded, dash, 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 compounded yearly, compounded half yearly, etc. When they use the word compounded, you can use this. Otherwise, you can use the simple interest. How do you calculate simple interest? Spot price into the rate of interest into the time gap. Now, what does T represents here? T here, and what does R represents? R is the rate of interest. And rate of interest, which rate of interest? You can take normally risk-free rate of interest. If that is available, risk-free rate of interest. If I use risk-free rate of interest, the value I get is minimum because risk-free rate will be minimum rate. So value will be minimum. But if I use opportunity cost, opportunity cost, then the value will be, in my opinion, what is the value. So there is no fixed number for this. If risk-free rate is available in the problem, use that, you get the minimum value. If you use opportunity cost, you get the expected value, but you get the fair value in your opinion. And T is the time gap. This is important. Time gap between today. Today means the date of transaction. Date of transaction and expiry date. Between date of transaction and expiry date. I don't think this requires a numericals. Anyway, we'll do problems and all. Interest you add. If it's simple interest, compounded they have given into 1 plus r to the power of t, or if they give continuous compounded, continuously compounded, e value given. So this concept what we apply is continuous compounded. When e value is given, it means they should give the word continuously compounded. Continuously compounded. This is the basic formulas. Fair value of futures. Any doubt here, my dear friends? Is it done? What is e-value? Please refer to day 1 discussion. We have discussed the basics so that you don't ask these questions here. E-value haven't discussed. Continuous compounding, how to calculate e-value. Compounded daily, compound monthly, how e-value is determined. Approximate value not required. That's why I told you e-value means e to the power of what? That should be given. E power 0.12, e power 0.13, whatever it is. If they're given in the problem in the exam, then you use. Otherwise, don't use. Otherwise, you can use simple interest only. And because the value will be very small, it's not going to make much of difference. Answer will be approximate. But for examination purpose, if e value specified, e power whatever required they've given, use this formula, continuous compounding. Otherwise, don't use. Use simple interest. Okay, let's go further. Okay, now next one. Okay, next, let's understand about impact of dividends. Impact of dividend. Now, please tell me, dividends when paid, what is the immediate impact on market price? We have discussed this during our dividend chapters. When the dividend is paid, what is the immediate impact? Immediate impact is the market price reduce. Market price reduce X dividend. Hope you remember. It's like distribution dividend is like withdrawals. The value per share will come, but the price per share comes down immediately on the date of dividend payment. That is X dividend date, X dividend price. Correct? So, what we are trying to do today is spot price. No doubt about it. We are trying to project what will be the price on expiry. Price on expiry. Now, in between these two, if you are expecting any dividend, What will happen to this price? Expected price, the future price, theoretically, because of dividends, expecting the dividend during this period, what do you think will happen to this price? As you just told, price will be reduced. So impact of dividends, impact of dividends on fair value of futures, fair value of futures. It is negative, impact is negative. Impact is negative. And what kind of dividend? Dividend expected to be paid. Dividend expected to be paid. Dividend expected to be paid between the date of transaction and the expiry date. Between the date of transaction and expiry date. What is dividend paid in the past does not matter. What dividend expected to be paid after expiry date does not matter. We want only till expiry date, only price till then. So what is going to be the formula? The fair value of future general price, general formula, spot price plus interest minus dividend. Minus dividend. Why? Because we need the price after the dividend, because the price will be at the end of the month, let's say at the end of the month after the dividend. So this is the price, x dividend price. This is x dividend price. Expected price after dividend. Expected price after dividend. So we will subtract. Okay. If it is compounding in nature, then what the formula is going to be? The fair value future is given by, if it is compounding in nature, if compounding, regular compounding, spot price minus dividend. Minus dividend. Now please tell me here, spot price is today, but dividend, if it is today, no problem. But if dividend is after 2 days, 3 days, 4 days, can I subtract dividend directly from spot price? Mathematically, today is spot price, present value, but dividend will be at a later date in time. So what do you think is the value I have to compute, I have to apply on dividends to bring it into today terms? I have to discount, which means I have to calculate present value of dividends. Present value of dividends. So when you subtract dividends, do present value of dividends. When you do compounding into 1 plus r to the power of t. Same thing goes for continuous compounding. For continuous compounding, don't think so many formulas. They are different in different situations. If you understand the basic concept application, formula you can write yourself. So if it is continuous compounding, the fair value of future is equal to, here also, spot price minus present value of dividends whole multiplied by e to the power of RT. The full form of R and T remains same. R, rate of interest, the risk-free rate or opportunity cost. T represents the time gap between date of transaction and the expiry date. So T represents not the time passed, T represents time remaining, like your life. Birthday, time passed, don't think about that, think about future, remaining time, what you can achieve. Remaining time to expiry is what is applicable for fair value of futures. Continuous compound. If E value is given, you can use this. But everywhere, when you subtract the dividend, don't subtract dividend directly, present value of dividends. Okay. Sometimes they might give you dividend yield in percentage terms. They will not give you dividend per share. They will give you dividend yield in percentage terms. For example, they will give you like this. Dividend yield 3% per annum. The thing is specified per annum. So in that case, how do we convert per share basis? Percentage, we apply it on spot price. Then we get per share basis. So much you more don't have to do. If dividend yield is given, you can write just one line. If dividend yield is given, if dividend yield is given, then what you should do? Consider R net of it. That is, if dividend is given, consider R, that is rate of interest in the formula, net of dividends. Net of dividends. For example, now rate of interest, let's say risk-free rate, they will give you 8%. And they say dividend yield 3%. Rate of interest 8%. Impact is positive, we should do plus. 3% dividend yield. Dividend impact is negative, we should do minus. So instead of doing plus 8 minus 3, directly you do net amount 5%. So if dividend per share given, then you do present value of dividend, subtract from spot price. If they have given dividend in yield, that means percentage is given. Dividend yield percentage is given. When you compute that R in the formula, write the net amount. Rate of interest 10%, dividend yield 2%, net R 10 minus 2, 8%. Hope you're able to get the concepts. In fact, to an extent, you will learn this in your accounting standards in days also. You know what they say regarding borrowing cost? Interest can be capitalized, but if you earn any income during that period, you should subtract it. Hope you know those concepts. What is the value of the asset? Value of the asset is the amount of expenditure incurred, like spot price, on that borrowing cost plus interest. And during that period, if you earn any investment by parking it in temporary proceeds that will generate interest, subtract. That is a concept which is applied here also. Cost of the asset, spot price plus interest minus dividends. If dividend is in percentages, you subtract. Okay, but computing fair value is fine. Applying this will do. In the exam, some problem will be asked on direct computation of fair value, we'll do it. But the question comes, is this. What if the fair value is not same as price? It was supposed to be fair value. It is not same as price. It's not same as theoretical minimum price. Then the difference offers you an opportunity that is called as arbitrage opportunity. What is meaning of arbitrage opportunity? You buy in one place, sell in another place. Let me give you that. Hope you have taken down till here. Let me also discuss about the theoretical aspects of arbitrage, because that is connected with this, and then we'll go for solving problems. Okay, one more thing I'll just add to this before I go further. One more thing. There is something called as commodity futures. The same thing. Futures where underlying assets are commodities like oil and like copper, gold, silver, etc. Commodities also, futures are traded. Some commodities, not all commodities, some commodities. But with respect to commodities, one more extra thing will come. See, even in the shares, to hold, you have to pay some charges for the depository participants. It's called as demat charges. But demat charges are very, very insignificant. So we don't consider while solving problems at all. We ignore it. Very, very insignificant, small. But when with respect to commodities, if you want to purchase the commodity and hold it, do you know there's one important expenditure to be incurred which is not required, which is not there in shares, financial assets. For physical assets, that will come. Can you think what could be that? It is, yeah, depreciation, correct. Stock holding, correct. Deposit, what deposit? If you want to have an asset, physical asset, to maintain the asset, you need to incur some expense. That is important expenses, rental expense. That is one element. It's called as carrying cost. It includes also insurance charges to be paid, because you, if it is there, means it can be lost. You have to pay, cover through insurance. Depreciation of the asset can happen. Various reasons. It can be pilferage will be there. Normal loss will be there. Various things will be there. All those things put together will call as carrying cost or rental expense to be specified. So if it is commodity future, you can add one more line. You can just add, for commodity future, for commodities, in rental expense also, storage cost, let's say storage cost, cost of carrying it, storage cost, also added. Storage cost also added for commodities. Others will be there. Storage cost also will be. Dividend they don't have it, but it's called as convenience yield. That is expected income by holding the asset. That you don't worry. But commodities, what you need to keep it in mind is storage cost will also be added. Storage cost will also be added. Interest will be added. Now, one more thing. Will you add interest on storage cost also? That's the interesting one. Will you add interest on storage cost? You will not add interest on storage cost. Why? Because storage cost is expected to be paid at the end of the period, on the expiry date. That's what we normally say. Therefore, no interest element on storage cost. But if the question says storage cost is in present value terms, present value of storage, if they mention in the problem, on that interest will be applicable. So generally, storage cost is at the end. Interest need not be added. But if the storage cost is mentioned in present value terms, then interest need to be added. Depends on what is mentioned in the question. Yield, 1 minute discussion on that. On shares, we get dividends. On physical commodities, do we get dividends? Yes, you get. For example, you have land and building. From land and building, what income you get? Rental income you get. That is the like a dividend, convenience yield, rentals. But sir, I'm having gold. I'm having oil. What dividend I receive? No, dividend you don't receive. But what is your expected yield? It's called as convenience yield, implied yield. Meaning, my expectation. What is my expectation? My today price is, let's say, gold price, let's say, is 10,000 rupees. 10,000 rupees. I want, by holding this, or I am expecting, if I hold this, I should get 1,000 rupees profit. My expectation, expected profit, therefore it should become 11,000, right? So this expected profit by holding the asset is called as dividend, convenience yield. It can also be understood in different ways. It's more of notional in nature. Definitely more of notional in nature for commodities. By holding the asset, what is my convenience yield by holding the asset? Notional in nature, not actual, notional. uh, for a company, you have raw material purchased. Instead of purchasing tomorrow, if I purchase today, I think I will save 1000 rupees. That saving what you do now, and you're expecting the price to go up, and that is called as dividend, convenience yield. From exam point of view, don't worry too much. What is this convenience yield and all? They will give you the amount, you just use it. If they give you convenience yield, simply subtract. If they give you present value of convenience yield, on this also you apply interest. Okay, commodity future, we'll take up one problem later, but that is not at all a complicated matter from exam point of view. Practically a lot of issues are there. From exam point of view, that much is sufficient. Okay, let's understand more important aspect now. If fair value is not equal to the price, what is the treatment? That we discuss it now. Okay, so what will happen when the price and value not equal? In case of future, we get something called as arbitrage. Let me explain you that. Going back to basics once more. What is speculation? Speculation means uncertain profit. You take a view, market price will go up. If it goes, profit. If not, loss. Uncertain, risk is there. Hedging is called as risk management technique. That is, you have a risk and you try to minimize that risk. We are yet to learn that. And now we are learning arbitrage. What is this arbitrage? Taking the advantage of imperfect market price. So there are two markets. Between two markets, one is cheaper, one is costlier. Everything is same. So what a normal person will do, from the cheaper market you buy, and from the costlier market you sell. So you buy, you sell, you buy, you sell. You make a riskless profit because same commodity is there. You get guaranteed profit. You buy in one market, sell in another market. So imperfect market price is there. You make profit. How long this goes? Is arbitrage opportunity illegal? Definitely not. See, when you buy in one market, what will happen to that market? Because you buy too much, the price will increase. And in the other market you sell, where the price is high, you keep on selling, the selling pressure, the supply pressure will increase, the price will come down. So over a period of time, the balance is maintained. So arbitrage opportunity is very, very short term, momentary in nature. You have to keep looking for it. That's why stock market traders, they're always in front of terminals. Keep looking for opportunities. The moment they get it, they do it. Practically, arbitrage opportunity is very, very less because everywhere software is there. So they will write a software program. The moment you find opportunity, make a place an order. So within a fraction of a second, it gets over. So practically, arbitrage, you can almost say, does not exist, almost, in stock market. But as a concept, you need to learn because it can be used in many other places, many other situations. So arbitrage is an opportunity. What opportunity? Because of price differentials. How do we apply? In the case of futures, we'll understand now. Okay. I don't know whether I told you earlier, I'll just tell you once more. Even in two markets, BSE, NSE, for a company share price, it must be same. Like for example, if BSE is 100, if NSE is 120, if it is there like that, what will do? People you buy in BSE, sell in NSE, buy pressure in BSE, sell pressure in NSE, and both price will get maintained. Let's say you will maintain an arbitrage price, you will maintain a equilibrium. So when you compare BSE price, NSE price also, it will almost be same. I've just taken a screenshot. Please look at it. On 2019, I taken a year back. So 731 is the price of Infosys. And if you look at BSE on the same date, same time, it is 731.95, 0.25. You can't really buy it and sell it because only 0.25 difference. The transaction cost will eat away all your profits. So almost same only. So difference will not be there. That is what is arbitrage concept. So if arbitrage is there the price will be same. If price is not same, there exists an arbitrage opportunity. Arbitrage have huge funds? No, arbitrage opportunity situation I'm telling. Arbitrage situation does not exist. Because arbitrage opportunities will take away immediately, it will be used by people. So it will not be there for a long period of time. So arbitrage will not be there practically. At least with respect to the discussion what we are doing now. Okay. Now, applying in futures. When arbitrage opportunity exists is what we just learned. When you say fair value, what you computed using the formula, that spot price plus interest minus dividend is not equal to the actual future price. When it is not equal, there exists arbitrage opportunity. So what strategy we can do? There are two choices. Either the future price is less or the future price is more. Only two situations, less or more. So when the price is less, please listen to my words carefully. I am thinking only from price point of view. When the price is less or when the price is more. Two situations. When the price is less. Now can you tell me what should be your regular strategy? When the price is less price is less, you should buy. What should I buy? What is underpriced? Is the spot price underpriced or the future price underpriced? Future price, right? Future price is underpriced, which means spot price is more. Only two markets. We are comparing two markets. Arbitrage means two markets. Which are the two markets? Spot market, future market. If future price is underpriced, means we have to make sure the future price is purchased. You take a long position. You take a purchase. You buy future. You take purchase position in future. Simple. Futures you buy. Futures you buy means what? You enter into an agreement to buy at a later date. Your future price is fixed. Simple now, keep it in mind. Price is less. So I will enter into future buy. What do you mean by future buy? Fixing the future price. Why am I fixing the future price buy here? Because it's underpriced. Underpriced means cheap. Fix it. You have opportunity now. Fix it. So future buy, that is when underpriced. Future price is theoretically present value plus interest. Correct? After considering that only I am telling. Future price, no, that is not future price. That is the fair value of futures. Present value plus interest is fair value. Future price is available from market. We discussed just now. In the break, everything you forgot. We are comparing the fair value and future price. I told you the heading price and future, one chart only, one slide only discussed. Don't equate it. Future value is spot price plus interest. Future price available from the market directly. When the future price is less, fix it. That's an opportunity. Make use of it. Fix it. Future buy. Block the purchase price. Purchase price. Future buy. And where will you sell? If future is underpriced, that means spot price is there. No, that is overpriced. I'll tell you once more. Just look at this example. You'll understand better. Look at this example. Suppose spot price is 1,000 rupees plus interest after doing all this calculation happens to be 100 rupees. So what is the fair value should be? Fair value should be 1,100. Correct? Spot price plus interest. But actual future price is 1,075. Which means this is underpriced. So buy 1,075 underpriced buy, which is which is higher than one market to buy is future. So which market you sell? What you sell in is spot market. This is high. So you sell. Very simple. You compare future, you compare spot price plus interest. Wherever it is cheaper, you buy. Wherever it is costlier, you sell. That is when future is underpriced. If future is overpriced, then opposite you do. In future, it is overpriced. Price is high. Sell it off. Fix it. Fix the selling price. Price is high. Fix it. Sell at a higher price. Spot is cheap. You buy in the spot. So you take one position, one market you take buy, in another market you take sell. So you buy in one market, you sell in another market, thereby you make a profit. There is no guarantee that future value will coincide with spot price or that date. Whether it will be coinciding or not, you will still make profits. Don't jump into conclusion too fast. On the day you are born, you can't become CA. Please hold on your thoughts. Understand slowly. We have not completed the finishing this topic yet. First, understand overall strategy, broad overview. Then we'll go to one by one specification. Let's see, we'll make a guaranteed profit or not. First concept, fair value of future. How do we calculate? Spot price plus interest minus dividend. Second step, compare it with future price. If it is equal, no problem. If future price is more overpriced, do one strategy. If it is underpriced, one more strategy. So which strategy to do is what I'm discussing now. I'm not giving you the full details here. I'm not giving any numericals. Please go only in that process. You are just entering into the derivative world now. You don't have absolutely no practical angle into it. You have not done anything in the practical because no CA office will do these things. They are not allowed to do also. So first understand it in a theoretical world in a stepwise manner. Okay. So the strategy when underpriced, you buy in future market and you sell in spot market. When the future is overpriced, you buy in spot market, you sell in future market. I hope you got the overall objective of arbitrage opportunity. To do arbitrage, we require two markets. One market to buy, other market to sell. Which are those two markets here? Spot market, future market. At a lower, at a price where less you buy, market where price is high, you sell. How do you identify where to buy, where to sell? You compare it with the fair value. I hope you got the overall objective of this. Okay, now let's take one by one. Arbitrage strategy, one by one situation. When the future is overpriced, first we'll understand settlement on delivery basis. Settlement on delivery basis. Then we'll go for settlement on cash basis, net basis. You remember this concept? Whether you settle by delivery basis or you settle by cash basis, overall profit remains same. The mode of operation can be different. Overall profit will still remain same. I'll prove how it remains same here also. But for examination, you can present it settlement on delivery basis, or you can present the answer on settlement on cash basis. I will discuss both. You can choose one of them to present your answer in exam. Both will be accepted. Okay. First, we'll focus on settlement by delivery basis. Okay. Let me take a numerical. Then I'll come to this summary of transaction. Such a numerical example, let's say. Okay. Just take a look at this. Don't write anything. We will have problems to solve later. Spot price 100. Term 6 months. Interest rate 12% per annum. Interest rate. Current spot price is 110. Now here, does arbitrage opportunity exist? What do you think? How do we identify arbitrage opportunity? We compare two things. We compare price and we compare value. What is the price? 110. What is the value? We have to calculate. Let's calculate fair value. Spot price plus interest. Let's take simple interest. Spot price is 100. Spot price is 100. Interest 12%. For 6 months, it comes to 106 rupees. So we are having fair value to be 106, price to be 110. Now what do you think? Is it overpriced or underpriced? Underpriced. I'm talking from price point of view, simple English. Okay, it is overpriced. See, 110 is right. Don't jump into conclusion. Sell, buy, I'll tell you. Wait. First, tell me, is it overpriced or underpriced? No, sir, 106 is less than 110. Under, sir? No, two numbers will always be one less, one more. You have to think from price point of view. Price is more. So which market? I mean, it is the situation of overpriced. Overpriced. Now, when it is overpriced, which market will you buy and which market you sell? So what transaction you do today? We have two markets. One market is spot market and one market is future market. Okay, so what transaction you do today? With respect to futures, let's discuss first with respect to this future transaction. Future is overpriced. Overpriced means think from the future. Future should be sold. Now, to be sold means you can't come on that day later. Today only you should enter into an agreement. So, what you should do? You enter into a future sell agreement. Today you don't sell. You just enter into a future contracts. Why sell contract? Because it is overpriced. So you have to sell agreement. The agreement should be to sell at that price. 110 is good to sell. It is high. It's good to sell. So arbitrage is always that you sell. And in spot market, what do you do? If you want to sell later, you need to have it. No. Today you purchase it and keep it with you. Future is overpriced means spot market is cheap. Only two markets, spot market, future market. If future market is costlier, which means spot market is cheaper. Spot market is cheaper, so you buy at spot market. But tell me, zero position, you have no money with you. If you want to buy the share at 100 rupees, where will 100 rupees come with you? You need to borrow. Correct. So if I have three markets for your reference, one is, let's say, spot or future markets, and another is spot markets. So in future market, we just discussed, you need to enter into sell, agreement to sell. Agreement to sell at 110 rupees. You sign an agreement. In spot market, you need to buy. Spot buy. Future sell means spot buy. Or you can say future short means spot long. Buy. At what price? You need to buy 100 rupees. Where will you get the money? You borrow. What market is it called as? It is called as money market. Money market. So in money market, you're going to borrow. In money market, you're going to borrow. Okay. Now, after this 6 months, after 6 months, after 6 months, what will happen? This borrowing need to be repaid. How much you need to repay? You borrow 100 rupees. Along with interest, how much interest expense? 6 rupees. So plus interest expense 6 rupees. So you have to repay 106 rupees. Can you please tell me, for you to repay loan, where will you get the money from? No problem, sir. You have purchased the share earlier, right? Buy. That share you sell. That share you sell. Please keep it in mind. We are discussing this under settlement on delivery basis. Don't think about square off. Don't think about cash settlement. Don't think about net settlement. We are discussing under settlement on delivery basis. Settlement on delivery basis means whatever agreement we have entered will be properly executed. Therefore, what is the price here? Earlier you entered into agreement to sell at one price. So at what price you sell? That price only you sell. At 110 rupees you sell. Your sell price is fixed. You agreed earlier itself. Therefore, you make a profit of 4 rupees. That 4 rupee is called as arbitrage gain, arbitrage profit. And what is that 4 rupee? Exact difference between the fair value of future and future price. We'll come to the net settlement basis later. But as of now, see if you are able to understand settlement on delivery basis, the calculations. So don't bring in concepts like mark to market, square off, the daily settlement, those things and all, don't bring it here. Settlement on delivery basis. Keep that in mind and see if you are able to understand. First, you understand settlement delivery basis clearly. Then I'll go for settlement under square off basis, under net settlement basis. When you do problem, I'll take care of it. Okay, any doubts on this matter? Complicated. Okay. If it is easy, then what's the point in you doing it? Everybody will do it. Only when it's complicated and you are the person who can make it simple and you can try understanding it, you become special, you will get paid and you are worth it. If you do easy things, why you need to join C, or what's the point in learn anything? When you learn, that means you're learning something which you don't know. So things will get complicated initially. As you move further, as you understand, it will be under your control. So in general, I always say, if you are afraid of facing complicated things, difficult things, you cannot face anything in life. You have to keep learning, facing difficult things. And that's why CA is there for, to remove the difficulties. If accounts is there clean, neat, you go sign it and come back and you get paid for it. Accounts will be dirty, it will not be clean, you need to go, you have to clean it up, you have to apply your mind. That's your profession. Anyway, so let's stick to this. Hope you got the numericals. Now some of you are asking question, the future will not be known. You know, because you fix a price and that agreement is going to execute it. You get the same profit. Even if you settle on net basis, I'll come to it later, you get the answer. Okay. First, let's just write down few theoretical aspects on these matters. and then we'll go for it. And we will read the format also quickly. So you can just give the heading, arbitrage in futures. Arbitrage in futures. So you write down, in general, arbitrage means buy in one market, where price is cheap and sell in another market where price is high. Then two markets in the current context are the two markets in the current context are spot market and future market. Then buy and sell is determined by comparing fair value of future and future price, fair value futures and future price. Future price. Okay, hope you got this one, basic one. Hope you've taken it down. Okay. Now let's understand situations now. Two situations are possible. Future price is greater than fair value, which is underpriced. Future price underpriced. This is situation of overpriced. The price is more overpriced. Or other situation, future price lesser than fair value. Only two things possible. Underpriced. So basically what you do is, what transaction today, what transaction later, and here also then whatever the particular transactions or markets. Here also markets, what transaction today and what transaction later. Okay, first we'll do this one. Markets are, first you determine future markets, in spot markets, in money market. In fact, this you have to remember three markets. You can't say you forget this. Look at the first letters, FSM. SFM. You can't remember these three terms. What do you do in future? What do you do in spot? What do you do in money market? If you forget this, forget about everything. Okay. First thing is, in future, you enter into a sale agreement. You do future sell. Future sell. Why it is future sell? Or you can say short position here. Why it is sell? Because overpriced. Future is overpriced. When overpriced means you have to sell. Future is overpriced. So you have to sell. Overpriced means sell. And once you sell in one market, other market you automatically buy. So you do spot buy. That is long. Thing is, you don't have to remember both. In one market you sell, which means another market you buy automatically. You always remember future, spot, opposite. Whatever you do in future, you do opposite in spot, vice versa. In money market, you are going to borrow. Later, everything will be settled. You can just say spot buy will be sell here, and this will execute or square off. Here, if it is a delivery settlement, you execute. If it is a net settlement, you square off. Both answer will be same. That you don't worry. And here you borrow means then you repay. Now once you repay, the numericals also we have seen. Overall net profit, what you get? Overall surplus is the arbitrage gain. And this should be difference between price minus value. This should be difference between the price minus value, or whatever you calculate it. Difference. This is difference between the price and value you got. So this is known in advance, and this should be riskless profit. This should not be any subject to uncertainties. This should be riskless profit. Okay. If it is underpriced, and remember, this you get the profit only if you have till maturity. If you want to sell before maturity, then you will be selling at a different price. Then overall profit or loss may come. This fair value what you computed is at the end of as on expiry date. So all this discussion will hold good provided you remain invested till maturity. Then you can get this profit. But for exam problem, it will be like that only. Okay. Come to the markets in the other case now. Underpriced. Future, what do we do? Spot, what do we do? And in money market, what do we do? Now, future is underpriced. Underpriced, which means what we should do in future market, what future transaction we should enter into, what contract we take our position in, what should be our contracts. Underpriced. Underpriced means in general we say buy. So future buy. Here we enter into future buy. That is, in futures we are taking long position. Okay. In spot markets, opposite. In future buy means in spot market opposites. So what we should do in spot markets? Opposite position, shorts. Short position. Short position means sell the shares. In future you are buying, in spot market you are selling. But to sell the shares you don't have shares, zero position. You don't have shares. So what do? You borrow shares and sell the shares at spot. You borrow the shares and sell the shares at spot. Now, when you sell the shares, you get money. That money, what you are going to do in money market, it is going to be deposit. It's going to be deposit. Okay. Next. Later, what will happen? You execute this agreement. If it is settlement on delivery basis, you execute. Or if it is settlement on delivery net basis, cash basis, you are going to do square off. If it is settlement on net basis, you do square off. Now, deposit will be there. Deposit matures along with interest. Deposit matures along with interest. And here, when you borrow and sell at spot earlier, now you need to repay the shares, means you need to buy the shares. Anyway, you have the agreements. So you buy the shares and you repay. Again, whatever the overall surplus, what we have, that is your arbitrage gain known in advance. That is your arbitrage profit. Known in advance. Arbitrage profit, riskless profit. Known in advance. Okay, so just go through it once more. See if you have any other doubts. Arbitrage profit gains, yeah, both are same. And when you buy the shares today and you sell later, you may get the dividend income also. Please keep it in mind. You may get dividend income. Dividend income. Please mark that. When you buy the shares and you sell later, the dividend income may come. And when you borrow and you repay, you will have interest expense. Please highlight this. In between that, when you buy and sell, in between you might receive a dividend, so dividend income. In between borrow and repay, you might have interest expense. And you borrow, and here a deposit matures, so you get interest income. In this case, please mark that also. Interest income. Interest income when you deposit. Similarly, when you borrow shares and you sell repay shares later, you need to will have dividend expense, dividend payment. Dividend payment. Dividend payment. One of the questions I got earlier, not answered earlier, I'll answer it now. In this case, why will dividend become payment? You receive and you pay. It's just inflow outflow. Why should you consider as payment? Here you borrowed the shares. In short position, I'm telling you borrowed the shares and you sold the shares. You don't hold it. You don't hold it, so you don't receive dividend. But you have to make a payment of dividend. Why should you make a payment of dividend? Because the holder who has lent you, had he not lent it, he would have received it. Had he not given to you, he lent it for temporary purpose. He wanted to become shareholder for throughout. You requested, please give me. I'll give you some charges. He said, okay, I will give you the shares, but any income associated with that, you should compensate me. That is, if I was a holder, I would have continued to receive dividend. Now, because I lent it to you, I lost that opportunity. So you, the borrower who got the share and sold it, has to compensate the lender for the dividend payment. So to answer the question who was asking earlier, dividend receipt will not be there, only dividend payment will be there, and hence it should be considered. Hope you mentioned it. Interest expense, dividend income, dividend payment, interest income. Where which one will come? Why there will be no receipt? Because you are not the holder. You sold it. You sold in spot markets. You sold it. You borrowed the shares and you sold it. So you will not receive the share dividend. But the holder, had he continued to be the holder, instead of giving it to you, you sold it, he would have received dividend. He would have received. So needs compensation. Hope that is clear. Okay, so this is the main one area. Speculation, we discussed the concept of futures. Problems we did. And this is about discussion on fair value of future, and fair value of future, if not same with price, we have to construct arbitrage opportunity. This is second level of futures. One more will come, that is hedging. That we'll take it up later once we comfortable with problems on these things. Any doubts in this matter? And regarding the square of settlement, when we do problem, we'll get more clarity. How on square of settlement also we get the same answers. Okay, just keep it in mind. In one market we take long position, another market we take short position. That much you keep it in mind. That's sufficient. Okay, good. Okay, so come to this problem. Come to this problem. Data given below relates to share price of X Limited. Hope you are able to get the question. Spot price 5,500. Time period 2 months. Interest rate 12% per annum. Find the fair future price if no compounding is done, compounded monthly, continuously compounded. Given e power 0.02 also. Under the case 1 above, compute the future price. I mean, when they say compute the future price, it means fair value. After 15 days and 30 days, assuming spot price on the above dates are 5,600 and 5,700 respectively. So whenever we compute something, remember it's always fair because future price cannot be computed. It is only market determined. Nobody can compute. It is arrived by market forces. But if they tell you compute the future price, it means we have to understand it is a value. Okay, no compounding means simple interest. First case, no compounding. Means simple interest. So let's do spot price plus interest. Spot price plus interest. Spot price given to be 5,500 plus interest for 2 months, time period 2 months. So on 5,500 for 2 months, the rate of interest 12%. So 5,500 plus how much interest coming to 110, right? So future price, fair value of futures 5610. No compound. Second situation, compounded monthly. Don't know if you remember the formula for compound monthly. Future value is calculated by spot price plus interest. Sorry, spot into 1 plus R, compound monthly R divided by 12, and in the power T multiplied by 12, and T will be in a number of years or number of months. Let's see if you remember. T will be number of years or number of months. T will be number of years. Once you multiply it by 12, then it becomes number of months. But T as alone, it is number of years. Hope you remember it. Very good. So spot 5,500 into 1 plus R, 12%, 0.12 divided by 12, whole to the power of T should be always in years. 2 months means 2 by 12. Then multiplied by 12. So this will give you 5,500 into 1 plus 0.01, that is 1.01 square. Square. 5610.55, I think. You see, hardly any difference. Because when the amount is small, difference also will be small between simple interest and compound interest. Only when the time is large, amount is large, then only will be different. Otherwise, approximate answer you'll always get it. And or you can use a simple interest concept for verification purpose, even under continuous compounding. Anyway, let's do continuous compounding. Future value equals spot into e to the power of RT. Here also, time is the number of years, R is rate of interest, which is 5,500 into 1 plus, not 1 plus, e to the power of R, 0.12, time period is 12 months into 2 by 12. So 5,500 into e power 0.01, 0.02, sorry, 0.02. And e power 0.02 they have given 1.02, 02, 02, 101. So 5,500 into 1.020201. You get 5611.11. Please observe the values are hardly different. So even when they ask you the problem on continuous compounding, you should always verify your answer by doing simple interest. Answer will be very, very close. Hope all of you got it. Before we go to part 4 and part 5 of the question, I will just like you to have a little bit of practical aspects. I'll go to the website and show it. These data points, that future, how to look at the price, how to look at the expiry dates, few small points so that you will have a more connection with the practical aspect. We will not do any trading, but just to have some data points from the websites. Then we'll do fourth and fifth one. Hope done till here. So I'll go to nscindia.com. Okay. I hope the website is visible. You're able to see the website, right? Okay. You can look at this is the new version. I'll just look at the old version, easy to show. Everywhere you can search it. Okay. So let's say I'll just look for regular thing. Reliance Industries stock has been down. There is a rumor that Mukesh Ambani is not feeling well. So continuously down. I also have in position. I'm making some losses on this one. Anyway, so Reliance Industries, this is the 1901. What do you mean by 1901? Today, if you purchase, I mean today you can't do, this was the Friday data. If you want to purchase it on Friday, you can see the date as well. I'll just show it to you. Okay. 2020 November 2020 close price 4 o'clock 3:30 you can say the close price was 1901, or if you assume this is for immediate purchase, if you want to purchase it today immediately spot price 1901. I mean today Sunday, but Monday if you want to purchase 1901 for purchasing one share 1900 rupees. Let us go to the derivative section. You can see equity derivatives. I'll select Reliance Industries. Remember the word 1900, easy to remember also. Okay. 1900. What was the number? 1901, is it? 1901. Okay. 1901. And this is 1901.4. You know, small difference, 0.4. Small difference only is there. Not much of difference. Small difference, only 0.4. Why only so much? Because expiry is coming. Which is expiry date? Look at this. 26th November. Why 26th November? Because 26th November is the Thursday. This Thursday is the last Thursday of the month, 26th. Therefore, 26 is the expiry date. What is the next expiry date? 31st December, next month. So December 31st is the last Thursday of December month. January 28th, that is the subsequent month. Only 3 months I told you. So for stock futures, we get only 3 months. But if I go to the index futures, we'll get more index derivative. You will have more a weekly expiry also. But anyway, look at 1901. If I go to December, let's see what happens. You see the number? It became 1907. Price slightly increased. 6 rupees. Almost 6 rupee increased. And 28 Jan. 1915. You see it's again increased. Are you able to understand? Let's see implicitly for 1 month what is the rate of interest. Please look at this. For December, it was 1907. For January, it is 1915. So 8 rupees for 1 month increase. So indirectly, if I calculate 8 rupee on 1917 is the rate of interest. Calculate how much it will become. Implicit rate of interest. 8 rupee on 1915. 1917, sorry. 1907, right? 8 rupee divided by 1907 into 100 into 12. This is for 1 month. How much for 12? 5.03%. 5.04%. That is what is risk-free rate of interest. Implied risk-free. Anyway, differently. Let's calculate from spot price. Spot price was 1900. Spot price was 1900 and on November 26 is 1901. So no, 1901 only. So 40 paisa is the premium, right? So 40 paisa 0.4 divided by 1900 into 100. This is for just for 4 days. How much for 365 days? Approximately you get the rate of interest. Anyway, so the point I'm trying to tell here is spot price to November end. Only 4 days. So small time value of money. And from November end to December end, slightly more because 1 month gap. From December to January, 1 more month gap additionally. So as the expiry date increases, the value also will increase. Look at the market lots. You see market lots 505. So what is the value of one contract of Reliance Futures? Multiply 1901 into 505. One value of one contract, one lot. 1901 into 505. 9,60,000. So if you buy one lot, 9.6 lakh, you don't pay. That is the exposure you have. How much you pay out of 9.6 lakhs? That depends on your broker. That depends on SEBI guidelines, which will keep fluctuating. Let's say around 30-40% will be margin, maybe. It depends on the stock, of course. When the fluctuation is too high, they will ask more margin. If the fluctuation is less, they will ask less margin. But whatever may be the case. Hope you are able to get some practical insights into it. VWAP is weighted average price. That's how it's calculated, weighted average price. That is the price into volume. Volume weighted average price. That is VWAP. Based on the volume, they have calculated volume of trades into the price divided by the number of volumes. So average price. They have calculated the average price. 1901 is the close price. 1926 is the average price throughout the day. So like that, you have index derivative also, like index futures. You have only Nifty, Bank Nifty. Okay, it's showing only the one time. Okay. Nifty have weekly also. It's not showing. And okay. Fine. Hope you got the idea as to some practical aspect. Any questions you want to ask? We'll go for the remaining part of the question. I'll just tell you once more. before we just go back. Let's say I select the December expiry date 1907. What do you mean by 1907? Today, if I enter into an agreement, if I say buy futures, I'm committing for a purchase price of 1907. Will I pay 1907 today? I will not pay. I'm fixing my purchase price. I'm fixing my purchase price. And on 31st December 2020, whatever the price prevailing on that day, I'm going to sell it off. Okay. So hope you got the idea about little bit of practical aspects. Okay. Let's go further then. Index futures. Index future I've discussed, right? Index future means underlying instrument is index, like Sensex, Nifty, and all. They cannot be settled on delivery basis, but they will be settled on net basis. Depends on how the index moves. Index futures also moves. You cannot buy index. You can buy index futures. I've selected now already. Stock index futures, index derivatives, Nifty, let's say 26 November, 12,854. Nifty was 12,859. They are trading 854, slightly lower. It's trading at a 4 rupee discount. Maybe some dividends are expected, maybe slightly lower. If you go to December, this will increase 875, slightly higher. If you go to Jan, it will increase further 886, even more higher. But practically, 95% of derivatives is not futures, it's options only. Anyway, theoretically in examination, both either futures also can come, options also can come. But practical dealing, which I do or any normal trader do, they will be dealing mostly in options only. That's where you have a lot of options, lot of choices, lot of alternatives. Okay, so a lot of strategies can be built around that. Here, not much of strategies are possible. Okay, hope you got it. Let's go back. Okay, hope the PPT is back. Okay, let's go for remaining part of the question now. Under case 1 above, what is the future price fair value after 15 days and 30 days, assuming spot price on those dates were 5,600 and 5,700 respectively? Okay, fourth one, fair value after 15 days. Let's say 15 days means half month, after half month, after 0.5 months, half. Okay, now after half months, and this is all asked under 1, means no compounding. So let's do under simple interest. Under simple interest. Spot price, that is fair value of future, is spot price plus interest. The spot price is given to be 5,600. See, given 5,600 plus on 5,600 12% for, please tell me the time period here. For how long? Let's see if we're able to get it. What should be the time period? T here. What should be the time period? Please remember, this time represents not how much time have been passed. I gave you example of your exams. I gave you example of your life. It's not about the time past. It's about the time remaining. In this problem, how much was the original time remaining? 2 months originally. Now 15 days over, 0.5 months over. You should focus on how much time remaining, not how much time passed. That's why I keep telling, don't worry over birth date. It does not matter. That much time is over. You are getting closer to your expiry date. Remaining time. I repeat, remaining time to maturity. Residual time to maturity. Okay. So this is 1.5 months. 1.5 by 12. Oh, because out of 2 months, 0.5 month is over. Remaining is 1.5 months. So 5,600 into 0.12 into 1.5 by 12. 84. So 5684. Remaining time. Please remember, this 1.5 is remaining time. Residual time to maturity. Residual time to maturity. Out of 2 months, 0.5 months over. That's how we got 1.5 months. Next, fair value after 30 days. After 30 days, that is after 1 month. Same under simple interest. Fair value equals spot price. What is the spot price after 1 month? 5,700 plus 5,700 into 12%, and out of 2 months, 1 month over, remaining 1 month. 1 by 12. So 5,700, I think you get 57. So that is 5757. Okay, so we are able to get this one. Okay, hopefully we can go further. Okay, let's go further. Okay, so come to this one. Suppose that there is a future contract on a share presently trading at rupees 1000. The life of the future contract is 90 days. And during this time, company will pay dividends of 7.5 in 30 days, 8.5 in 60 days, and 9.3 in 90 days. Assuming the compounded continuously risk-free rate of interest is 12% per annum, you're required to find out the fair value of the contract if no arbitrage opportunity exists. No arbitrage opportunity means what? Fair value is equal to the future price. Value of cost to carry given e power minus 0.01, minus 0.02, minus 0.03 and e power 0.03 is given. Okay. So they have given the information about dividends. So you know what is the impact of dividends? It should be subtracted. But while subtracting, keep it in mind, you can't subtract dividend fully because spot price is today, dividend may be after some point. So to bring it to today value, we should compute first the present value of dividends. And how many dividends we have? 1, 2, 3. 3 dividends we have. All of these 3, we should bring it into present value first. And which present value to be applied? They have given continuously compounded continuously, and they have given e values. So you have to make use of the continuously compounded information. E value is available. Okay, so first we'll compute the present value of all dividends one by one. Future contract is buy or sell, does not matter. Why should we even worry about it? For one person it is buy, for other person it is sell, but both the person's price is same only. When I say market price, for one person is buy price, for other person is sell price. And they're not asking us to compute profit or loss here. So no point in computing buy price, sell price. It's only one price. The price traded on a particular date. For example, Reliance and all we have looked at 1901, 1907 on a particular date, like that. Okay, so first we'll calculate the present value of all dividends. We have three dividends. Dividends after 30 days, 60 days, 90 days. Dividend after 30 days. Dividend after 60 days. Dividend after 90 days. So all of these things we require present value one by one. Now remember the formula for future value, basic formula for future value. Future value of compound interest is present value into e to the power of RT. So if I want to calculate present value, it is future value divided by e power RT. It can also be represented as the future value multiplied by e power minus RT. Mathematical property. When e to the power of RT, denominator goes to numerator. The plus RT becomes minus RT. The property of indices, law of indices. In denominator, when you take it to numerator, the sign of the power will be changed. Plus becomes minus, minus becomes plus, vice versa. Why I am doing it? Because in the problem they said e power minus, e power minus, e power minus. So I have to make use of those things. Let's do the present value. How much amount received? 7.5 rupees. 7.5 rupees into e to the power of RT, rate of interest 12%, time period 30 days, let's say 1 month. Or you can do 30 by 365 also. After 60 days, how much? 8.5. 8.5 into e power minus 0.12 into 2 by 12. 60 days, 2 months. Then 9 rupees. 3 dividends, 9 rupees into e power minus 0.12 after 90 days, 3 months, 9 by 12. 7.5 into e power minus 0.01, 01. 8.5 into e power minus 0.02, and this is 9 into e power minus 0.03, which is given in the problem. All these values 0.9905, 0.9802, and 0.9705. So calculate all these values. Seven 7.5 into 0.9905, 7.43, 8.5 into 0.9802, 8.33, and 9 into 9.9705. 9 into 0.9705, 8.73. And if I add all, total 7.43 plus 8.33 plus 8.73, 24.49. This is the total present value of dividends. Then fair value of future. Fair value of futures, that is e power is given. So spot price minus the present value of dividends whole multiplied by e power RT. Spot price is 1000, trading at 1000, currently trading at 1000. Minus present value of dividend, we calculate just now, 24.49 into e power RT, e power 0.12 into 3 by 12. Thousand minus 24.49, 975.51 into e power 0.03. E power 0.03 given in the problem, 1.03045. 1.03045. So multiply 1005.21. Some decimals here and there can change, but that's fine. Could we have subtracted the future value of dividend from spot e power x? You can do it. That is also possible. That's also fine. So you compute spot price into e power RT minus future value of dividend. But future value of dividend you need to change, remember. After 30 days means 30 to 90 you do. So you should compute the future value of 60 days. Now 60 days to 90 days. So 30 days. 90 days to 90 days. So 0 days. And you need to compute e power RT. But e power, those values are not given. Only e power minus numbers are given. So we can mathematically calculate using the future value of that, but I don't recommend that. Let's stick to the present value concept. Okay. So present value of dividends we have done. Fair value of futures we have done. They also asked cost to carry. Cost to carry means the rate of interest what you have. Difference. Cost to carry. Differential amount. Cost to carry. Future price minus spot price. The interest element. Future price minus spot price. So future price is 1005.25 to 1005.21 minus spot price is 1000. So cost to carry becomes 5.21. 5.2. Hope it is done. Okay, I'll go further. Okay, so come to this problem. A future contract is available on R Limited that pays annual dividend of 4 rupees and the stock is currently priced at 125. Dividend per share 4 rupees, current price, spot price 125. Each future contract calls for delivery of 1000 shares lot size in 1 year daily marking to market. Corporate treasury bill rate 8%. Corporate treasury bill risk-free rate of interest. Required. Given the above information, what should be the price of one future contract, one lot? What is the price? We can't compute price, sir. But they're asking price. So in the exam, you can't say price cannot be computed. How dare you ask this question? You can't say that. We have to interpret based on the context. What is the context here? Price of the contract cannot be computed. So, but they're still asking, we will equate it to fair value. So we'll say under normal circumstances, we assume fair value equal to price and we'll compute fair value. Hope you understand. In the context, we have to interpret. You know, in law also you would have learned. Based on the specific context, we have to interpret. In English, they say, behind every successful man, there is woman. If you want more success, don't interpret like the way what you're thinking. If you want more success, more hard work you should put in. So in the context, we have to interpret. That's how the human intelligence is different from machine. Okay, if the company stock price decreases by 6%, what will be the price of one future contract? As a result of company stock price decrease, will investor that be long position in one future contract realizes gain or loss? What will be the amount of his gain or loss? Okay, let's understand. So first, price of one future contracts. Price of one future contract. Please, let's say future price based on fair value because no information. Future price is based on fair value. Okay. Now in this problem, they have not given any E value and all. So don't worry about continuous compounding. When they have not given, you don't try to do circus of computing e value just because you know it. E power x, e power 0.12, that is a e power x formula. Hope you remember. 1 plus r square by 2, r cube by 6, r to the power 4 by 24 or 12. Hope remember those formulas. Anyway, so we don't have to calculate. If they're not given e value, simple, don't do it. Let's go for simple interest compounding. So fair value of future price for 1 unit is spot plus interest minus dividend, if any. Simple interest only will apply. So spot price currently trading at 125, interest 8% for 1 year. See, this is for 1 year, okay? This is for 1 year. This is for 1 year. So on 125, 8% for 1 full year. Minus dividends. Dividends annual at the end only. So no need to do any present value. This is payable at the end. So this is already in future value terms. No need to do any present value. So how much you get? 125 plus on 125, 8%. 10 minus 4. 131. And value of one contract, that is for lot size of 1000. So multiplied by 1000. For lot size of 1000, value equals 131 into 1000, 1,31,000. That's the price of one future contract with lot size of 1000 units. Okay, second part of the question. If the company's stock price decreased by 6%, what will be the price of one future contract? Okay, if price decrease, price means spot price of the share. If the price decrease by 6%, so what will be the revised spot price? Revised spot price from 125, subtract 6%. 1 minus 0.06, I'll subtract. Degrowth, coming down. 6% you subtract. You get 117.5. Therefore, future value equals spot price 117.5 plus interest on 117.5 into 8% for 1 year minus dividend. $9.4. So 117.5 plus 9.4 minus 4. 122.9. So for lot size of 1000 units, value multiplied by 1000. 1,22,900. And just for observation, they have not asked how much the future value down by now. 131 to 122.9. How much down? It should be approximately that. 6.59%, right? Just to tell you, it need not be same. Mathematic reasons, but approximately same. 131 coming down to 122.9. 122.9 minus 131 divided by 131 into 100. Approximately you get, no, 6.18. 122.9 minus 131 divided by 131 into 100. Or 6.18%, sorry, 6.18%. Approximately same answer you get. Not exactly, but approximately. Whatever is the change in the spot price will be similar change in the future price, approximately. Okay. As a result of the company's stock price decrease, will the investor as a long position in one future contract realize gain or loss? What will be the amount of gain or loss? You tell me, if you take a long position, what is your view? Your view is in long position, market price to go up. In this case, price went down. It's against your expectation. When the market price is down in long position, you incur loss. And how much loss? Whatever the percentage decrease, we have to apply. Let's calculate simple one. So in long position, decrease in price, fall in price, results in loss. And they're also asking the amount of loss. Let's calculate loss per contract. One contract. Loss per one contract. So what is the share price falling? From 131, it went down to 122.9 future price. And lot size is 1000 units. You can multiply it by 1000. So you get 8,100. Or directly you can do. What is the value of one contract? It was 1,31,000. And now it became 1,31,000. Value of one contract became 1,22,900. You subtract, same number you get 8,100. Okay, hope it is done. Okay, let's move on. Okay, so come to this problem. Come to this problem. On 31st July 2011, the value of stock index was 2,200. The risk-free rate of return has been 9% per annum. The dividend yield on its stock is as under. Jan to December, dividend yield. Please understand, when they tell you dividend yield, it is percentage per annum. They have not specified implied. This is all percentage per annum. Assuming that interest is continuously compounded daily, find out the future price of contract deliverable on 31st December given E power value, E power value. Okay. So in this problem, we have information about dividends. So you know what we should do with this when there is information on dividends? We have to subtract the dividend yield from the rate of interest. Now we have 9% is the rate of interest. Which dividend will take? So many numbers are there. Which number do we take? Everything is per annum basis, remember. So which number do we take? We don't take all the numbers. We take the numbers relevant for our holding period. Remember, dividend before the date of transaction does not matter. Dividend after the expiry date does not matter. We have to calculate the contract deliverable. This is the expiry dates. This is the expiry dates. And we are on 31st July. You see first line and then last line. 31st of July. This is the date of transaction, date of valuation. Date of transaction, date of valuation. So which are the things we should take after July? After July means we will take August, September, October, November, December. These things to be taken, not the dividend before 31st of July, before 1st of August. We take only the dividends between the date of transaction and dividends between date of transaction and the expiry date. Date of transaction 31st of July and expiry date 31st of December. That 5 months. Only that will take August, September, October, November, December. And one more thing, these are all per annum basis, but we need only for the month. So how do we do? We need so many numbers. Which number we take? We don't add all the numbers. These are all the dividends respected months. But we want not all of them. We want single number representing all these numbers. So please tell me how to convert all these numbers convertible into single number. Because these are all per annum basis. My rate of interest is also per annum basis. Simple. We take an average. So we are going to take an average of this. So we'll say average dividend yield applicable for period between 31st July and 31st August. Between 31st July and 31st August. And one more thing. This is an interesting sentence. Please read. Continuously compounded daily. What kind of English is this? We know compounded daily. We know continuously compounded. How can you have continuously compounded daily? We don't have that concept. Because E value given, we can say continuously compounded. There is no concept of continuously compounded daily. That makes no sense. That's a clear mistake. Again, we can't say it's a mistake. We'll understand. We'll ignore the word daily. Like in English, there are silent letters. Like here, ignore silent word. That daily has no impact. Continuously compounded. Continuously compounded daily has no meaning of it. In English, sometimes we use those kind of things. Like we have a small crowd. If crowd is there, how it can be small? And some people say naturally acts. If you act, how it is natural? Or some people say a little more. Or some people say happy married life. See, these things don't go hand in hand. So you will have all these kind of things. Anyway, so let's come back and let's calculate the average dividend yields. 52252. Okay, 52252 divided by 5 months divided by 5. So how much average it comes to? 5 plus 2 plus 2 plus 5 plus 2. 3.2%. Okay. Now when a dividend yield is given, rate of interest should be on net basis. So our net rate of interest adjusted for the dividend. Risk-free rate is given to be 8%, 9%. So 9% minus 3.2 dividend yield, net will become 5.8. 5.8. Again, they're asking find out the future price. We can't compute the price. We'll compute fair value. Future price based on fair value. So F equals spot price into e power RT. No need to subtract dividend. Dividend is already subtracted when we will take the rate of interest. No need to subtract once more. Spot price of the index. Index 2200 into e power RT, e to the power of 0.058 into you can take 4 months or you can take number of days. Both are fine. Let's see 4 months will match. If 4 months does not match with e value, then we'll go for number of days. Let's say 4 months. No, not 4 months, 5 months. No, August, September, October, November, December. 5 months, 5 months into 5 by 12. 5 months. So 2200 into e to the power of 0.058 into 5 by 12. 0.02417. 0.02417, which is given exactly e power 0.0214. So 2200 into 1.02446. So we get the future price fair value. 2200 into 1.02446. Sorry, 2200 Okay, so you get 2253.81. 2253.81. Yeah, answer is wrong in the answer hint. You can correct the answer hint. In the book, you can correct it. Usually dividend yield will be higher than risk free rate? Never. Never. I mean, generally, definitely not. Risk-free rate is always more. Dividend yield will always be less from a stock. In general, we consider in Indian context, dividend yield is around 1.5% on the index, and risk-free rate is around 5 to 6%. Dividend yield will be usually be lesser than the risk-free rate. Exceptional cases are there, but usually it will be lesser. In this case also. You're always better off investing risk rate. Wow, risk-free rate is less. I mean, risk-free rate is more. If you compare between dividend yield and risk-free rate, yes, risk-free rate is more. But when you invest in shares, you not only get dividend yield, you get price return also. So if you compare between dividend yield and risk-free rate, yes, definitely risk-free rate is high. But when you invest in shares, you get price appreciation also. Capital appreciation will be there. That you will not get it when you invest in risk-free. Cost to carry is the difference between spot price and future price. Correct. The difference between spot price, future price is called as cost to carry because that is the cost of holding a stock. You can say expected return and the opportunity cost. The expected return is nothing but opportunity cost, is nothing but cost to carry. That is the cost that you need to recover by holding the asset. Absolutely correct. Difference between the price and future price and difference between future price and spot price. Let's say cost to carry. Just 1 second. Okay, let's go further. Okay, so come to this problem. Come to this problem. The following information is available about the standard gold. Please come to this problem. Okay, fine. So what we have, hope you got this question. Okay, so this is about the commodity futures. What is the commodity future we got? Let's say the formula once. Commodity future. Future value is calculated by spot price plus interest cost plus storage cost also will be there. The storage cost will not be there in regular financial instrument futures. And minus dividend. We don't say dividend here. Here we say convenience yield. Because you don't receive actually. It's a notional thing. Convenience yield. Yield. This is the expected income. Expected income or saving in cost by holding the asset. Expected income in saving in cost or by holding the asset. It's like, see, when we calculate price of a product, we always add opportunity cost also, right? So spot price plus expected profit. That's what we are adding here. Spot price plus convenience yield. The dividend, the income expected by holding the asset. So practically, usually we don't compute future price. I told you future price will be available in the market. And we compute this convenience yield as a balancing figure. And we call this as implied convenience yield. We call this as implied convenience yield. Anyway, just write down the formula once more. Spot price plus interest minus plus storage cost minus convenience yield. Convenience yield means expected income, or you can say opportunity cost or saving in cost by holding the asset. Okay, hope you have taken the formula. Any doubts in the formula? Please get clarified. Then we apply on this problem. And usually storage cost will be in future value terms. Usually in future value terms, normally. The storage cost normally in future value terms. Convenience yield is also normally in future value terms. Write the formula. Let me know if any doubts in the formula once more. Then we'll apply on this problem. Any example for convenience yield in case of gold? Yes, your expectation is your convenience yield. Gold price 10,000 today, let's say. You are expecting 2,000 rupees. You want to have the profit. Your expectation by holding the gold is 2,000. So convenience yield is 2,000. So it become 12,000. So normally we don't go that way. Normally we'll see what is the market price. Market price 11,500. So implied convenience yield is 1,500. Oil oil price, let's say $30 per barrel, and that is spot price. Future price is $31. So implied becomes $1. So we interpret based on that. Of course, we have to adjust for storage cost also. We have to remove the risk-free element also. The excess only is called as expected profit, nothing but convenience yield by holding the asset. Hope you got the points. Okay. Let's go further now. Okay, application now. Formula we have written. Let's see what information available in the problem. Spot price 15,600. So spot price 15,600. Oh, future price also given. That's what normally given, 17,100. Plus storage cost. Please observe. Storage cost 900. Storage cost 900. But please tell me, storage cost is normally in future value terms, but they said present value of storage cost. So what is the interpretation of present value of storage cost 900? When we compute interest, it will be on spot price and it will be on storage cost. Both interest has to be calculated. Hope you are able to get this one. And minus convenience yield, and that's what they're asking, convenience yield. Present value they have to calculate, we'll come to it later. So minus convenience yield, which we have to calculate. So what is going to be interest on storage? This is 17,100, I'll keep it as it is. This is 15,600 plus 900. Interest should be on both. Rate of interest 8.5%. 8.5% on 15,600 and 1 full year. So you don't have to multiply but number of years, number of months or something. Plus 8.5% on 900 minus convenience yield. So 17,100. This is 15,600 plus 900. How much you get? 8.5% on 15,600. 1,326. And 8.5% on 900. 76.5 minus convenience yield. Okay, so what is going to be convenience yields? $15,600 plus 900 plus 1,326 plus 76.5 minus 17,100. Again, please write it. This 900 storage cost in present value terms. Don't forget that. They have given in present value terms. So I'm applying interest on storage also. Otherwise, it would not be required. So how much convenience yield comes to? 15,600 plus 900 plus 1,326 plus 76.5 minus 17,100. 802.5. Now, convenience yield will be in future value terms normally. In future value terms. Storage cost also in future value terms. Convenience yield is also future value terms. It's at the end of the period. But in the question they asked, what is the present value of the gold? So present value. Present value, PVC they are asking. present value of convenience yield. How do we calculate? Future value by 1 plus r. So 802.5 divided by 1 plus r. 1 plus 0.085. 1 plus r. Future value by 1 plus r. Present value. Divided by 1 plus 0.085. So 739.63, approximately 740. So this is about commodity future, a simple problem. Nothing else can come beyond this on this. So what do you mean by this? This 740 is the implied expected profit by holding the asset. By holding the asset, in this case asset is gold, by holding gold. So when you hold, some people attach value into it. I have gold, I feel happy. How much happy? This is what they are much happy, when increase in price. Because of this convenient yield, they are expecting so much of price. Okay. Hope it is done. Okay. So this is about commodity futures. Problem also we have done. Okay. So good morning, my dear future chartered accountants. I hope my voice is audible and the PPT is visible. Can you please confirm it once first? Yes, thank you. So we are doing derivatives to be specific futures, and in futures we were discussing about speculation. So if you consider future as a standalone discussion, it is definitely a speculative in nature. It can also be used for arbitrage. Conceptually we discussed. So basically we compare future price and future value. And if price is more, overpriced. If price is less, underpriced. If future price is more, that means in future we sell and in spot we buy. And accordingly we take a position in money market. If future price is less, underpriced. So in future we buy, in spot we sell, and corresponding position we take it in money market. So that's what the brief thing on the arbitrage. Let's take a problem. Come to this problem. The following data relate to Anand's Limited's share price. Current price per share 1800. 6 months future price per share 1950. Assuming it is possible to borrow money in the market for transaction in securities at 12% per annum, you are required to calculate theoretical minimum price of a 6 months forward purchase and to explain arbitrage opportunity using settlement by delivery basis, using settlement by net basis. So in this problem, we'll understand both. And keep it in mind, most of the institute solutions, they have given a settlement by delivery basis. In the exam, you can choose either of them. You need not show both. I have just added here for our reference under both the methods. In the exam, you can use only one of them. Because ultimately, overall profit will remain same. Okay, so let's start. So first step is going to be computing the fair value of futures or fair future price. fair value of futures. Then we compare with actual future price. And we decide either it is overpriced or underpriced. Once it is overpriced, we take one strategy. Underpriced, we take one more strategy. And whatever position we take in the future market, we are going to do opposite in spot market. And by computing the net amount, net cash flow, we'll be able to get the amount of profit which should be known today. Let's do it now. Hope all of you got this question as well. Okay. First, you compute the fair value of future. They have not given any E value and all. So let's go with the simple concept of interest. Spot price plus interest. 1800 plus 1800, 12% for 6 months. 6 months futures. 1800 the spot price. Risk-free rate of interest is 12%. So you get 1908. But actual future price is 1950. Please write down till there. Okay. Now, please tell me, do you think is it overpriced or underpriced? Fair value is 1908. Future price is 1950. Please think from price point of view. Is the price high or the price less? Price is 1950. So, is the price more or is the price is less? Overpriced or underpriced? Price is 1950, higher, therefore it is overpriced. And overpriced, what is the strategy in 3 markets? Overpriced starts from future, future is going to be sell, and opposite in spot. And if you want to buy, you need to borrow money, that is borrow money in money market. So first let us understand 3 markets, what we have discussed as that is in future market is going to be sell because overpriced, and opposite transaction in spot which is buy long position, and money market to buy you need to borrow. So overpriced means what are the transactions in future markets? You are going to sell because whenever it's overpriced means you have to sell. And in spot markets, you have to buy. That is, in one market you buy, in one market you sell. That is the nature of arbitrage. So that is opposite of future. Whatever you do in future, you do opposite in spot. And in money market, because you want to buy shares, you need to borrow money. Borrow money for buying shares. Borrow money for buying shares. Okay. So today, what transactions you are going to do is you are going to sell future. In the sense, you are going to enter into future sell. How future market is short? We are selling in the futures. Selling first is called as shorting. You are taking a position of selling is called as shorting. You are entering into future sell transaction is called as shorting. Because future is overpriced, future price overpriced, future should be sold. That's what we are doing now. And future sell, when you enter into a transaction of sell, that's called as shorting. I hope you got the point. Okay. So sell overpriced and sell means shorting only. So whenever you use the word sell, sure, you enter into an agreement to sell, that means shorting concept. You take a short position. You sell in future, you buy in spot, that means it's short in future, long in spot. You can remember, whenever I say buy first, that is equal to long, and when I say sell first, that is equal to short. Both are same only. Okay, now so whenever something is overpriced, we take a short position because we know something is high. It's better to be sell. Later you can buy, but better to be sold first because it's high, overpriced. That's a short position. When something is less, good, buy it. Buy it first. And we know it's underpriced. Tomorrow it will become high. Tomorrow you can sell it later. But today it's cheaper. So you take a long position, expecting it is going to be high. Today it's less, underpriced. Anyway, so when you think too much about it, you will get confusion. But think slowly, you'll be able to get the concept. Okay. Now, so because in future you want to sell, in spot you have to buy. You have to buy at spot rate 1,800. And where you get the money 1,800, you need to borrow. And rate of interest available in the market at 12%. Or if it is your own money, it can be opportunity cost. Okay. You can present the exam in the same format. It's very simple, neat, right? You can definitely present it. There is no confusion here. Anybody can understand. Okay. So what we do on transactions on expiry, all these transactions will be settled, right? So this contract what you enter need to be executed. What agreement you have entered need to be fulfilled because settlement by delivery basis. Whatever contract you enter, we will deliver. We will execute. We don't cancel. We don't square off. We don't settle on net basis. And you bought in spot market. Now you sell at this price only. You sell at the price what you agreed upon. You sell at 1950. You bought at 1800. Now you sell at 1950. And you borrowed earlier. Now you repay interest of same 108, 12% for 6 months. You get 108. Okay. So net amount, you can do it on profit calculation. Net amount can be computed on cash flow calculation. You can choose either of them. Please observe here. Many people have confusion here also. So net profit can be calculated either on net terms, I mean profit terms, or cash flow terms. Cash flow terms. Not both. You can't mix the both. Now, if I consider cash flow terms, how much you are selling at, cash flow happening on transaction expiry 1950 is received, and you are repaying 1908, cash flow going out. You are not talking about profit here. You are not talking about expense here. Money coming in, cash flow coming in 1950, cash flow going out 1908. So net cash is 42. And in case of net method, if you want to follow, that's also fine. You are buying at 1800, selling at 1950. So net profit is how much? Net profit 1800 you buy, 1950 you sell. So net profit you have is 150. And you have paying interest expense, opportunity cost, interest expense 108. Therefore, net profit is 42. So either do it on cash flow basis or do it on profit terms. What is the profit in each of the markets separately? Don't do both. That will confuse you. So either cash flow, what comes in, what goes out, or in each transaction, what is my expense, or in each transaction, what is my income and what is my net profit. So you can do either on cash flow basis. So this is cash flow basis and this is net profit basis. In SFM, for us in this short term, both are same because we will not have any non-cash items. Both will be same. But what is this 42 rupee difference? That's exactly the difference between value and price, what we have identified the opportunity as. Okay, hope it is done. Any doubts on this one? Any question on this one? Is it done? Okay. So this is settlement on delivery basis. What is the interpretation of settlement on delivery basis? Whatever the transactions we have entered in future market, we are going to execute. We are going to execute. Suppose if you want to understand settlement on net basis, we should get the same profit, but the difference is this agreement will not be executed. This agreement will be cancelled. And what is the meaning of cancellation? We are going to cancel at the square of price. So if you want to explain the concept through settlement on net basis, then we will illustrate with the help of a square of. So by doing square of, then we get the profit, but overall profit still should be same, which is predetermined in advance. Let's understand that now. Settlement on net basis. If you want to illustrate this arbitrage strategy on a net basis, which is more realistic, practical in nature, because this is what we do. But theoretically, both are possible. Even practically, some people do it on delivery basis, but mostly is on net basis. So practically, this is more relevant, but exam point of view, both are accepted. Executed means we are short. No, future must be long. No, I not understand what is your doubt. Executed means you have entered into one contract. That contract you will fulfill. In this example, you have agreement to sell. So you will sell the shares. And where will you sell the share? In spot market, you already bought it. So when you bought in spot market, you have shares with you. And in future market, you have short position, means you are going to agreement to sell. And you are going to sell it as per the agreement terms. So whatever the agreement you have entered, agreement to sell, you are going to sell it physically, that is that you will deliver shares. If it was agreement to buy, you will pay cash and buy shares. Both you will do if settlement is on delivery basis. But now what we are discussing, settlement on net basis, where it is going to be explained with the help of square of. The agreement what we enter earlier, we are going to square it off. We are not going to execute it. If you use own funds, then no interest. Yes, but there will be opportunity cost. That's our day one discussion. Whether you use your own money or you use others' money, it will always have a cost. Either in terms of interest cost or in terms of opportunity cost. For SFM purpose, for us, in all the transaction, there will be a cost. Just because it's your own money. I give an example. If it is your own house, also will have a notional cost. Because if you are living means you are giving up interest cost, opportunity cost, interest income. So while discussing all these strategies, whether the money is your own or the money is borrowed, both will have a cost. So when you are trying to compute the profit, both type of cost should be considered. So own funds or borrowed funds does not matter. Whatever the rate of interest given in the problem, we have to apply, and that will come as a cost, either interest cost or opportunity cost. Any other doubt still? Okay, so arbitrage strategy when the settlement is on net basis. Again, I repeat, net basis means the agreement what we enter is not going to be settled, it is going to be cancelled, meaning in the process of square off. Let's see how it happens. So we know, again, I'm repeating the same process here. Value is 1908. Actual future price is 1950. Given the problem, actual future price is 1950. Price is high, overpriced. Therefore, position is going to be sell in futures, in the case short position in futures, and long position in spot. Sell means short, buy means long. So whatever position you take it in future, opposite in spot. Okay, so in future market, in spot market, money market. Transactions today, that will remain same. Future, you are going to sell at 1950. In spot market, you are going to buy at 1800. You borrow 1800. These three transactions, what you today, remain same in both the cases. Settlement on net basis, settlement on delivery basis. Because settlement difference comes only on expiry. Today, when you're entering into transactions, that is remaining same. The expiry date does not matter. Then on expiry date, now we are going to explain. So the first column, what you're doing today, what we're doing remains same under both the type of settlements, because settlement differential, difference in settlement will come only on settlement, on expiry. Now that we discuss after 6 months. This is an interesting point. Don't write down yet. I'll give time to write down. Future sell 1950. What we did in the settlement on delivery basis, we executed, right? We executed this. Properly we executed. That means we sold at 1950. We received the money 1950. We sold the shares as per the agreement. Here, we are not going to execute on net basis. We are not going to sell it. We are going to square off. Now, can you please tell me at what price we are going to square off? Now, don't think from arbitrage point of view. Take away the concept of arbitrage for the time being. Just to focus only on future markets. Only on future market you think. Today, you have sold at 1950. Now, if you want to do square off, at what price you are going to do square off? 1950. So today you sell at 1950. Tomorrow you buy at 1950. So sell at 1950, buy at 1950. Please refer to the earlier discussion. But before going to the amount, take the concept first. Don't think about the numbers. 1800, 1950, we'll come to it later. First come back to the concept. Please tell me how the square off process will happen. What is the meaning of square off process? Again, you're answering price more than 1950. Please don't give me numbers first. Think concept. Numbers will come automatically. You are entering into future sell at a fixed price. Now, if you want to do square off, you are going to do future buy at what price? Not number. I don't want number. I told you. When you enter into future market, will you know both buy price, sell price? I'm not talking about arbitrage here. I'm talking about the straight concept of futures. When you enter into future, will both buy price and sell price, both price be fixed? If both price is fixed, then my entire teaching or what I've done yesterday is a waste. What is the concept of speculation we discussed? Short position, long position we discussed. Practical aspect, I took to the website and showed you in fixed. What is that? Everything is going to be a waste. Everything is wasted basically. If you say, when I transact in future market, I'm not talking about other things. If I transact in future market, if my both buy price, sell price is fixed, That is the price at which I enter and the price at which I exit. If both are fixed, I really don't know what we discussed yesterday then I get stuck. I really don't know how to proceed because everything is like just washed away. The basic concept of future, this basic concept what I discussed yesterday in so much in detail is one simple concept. In future, one of the prices only you fix, not both the prices. That's why it's called as speculation. You fix the sell price, buy price you don't know, buy price will fluctuate, so your profit will fluctuate. That's why margin money is there. That's why you prepare the margin account, where as and when the every daily prices change, your profit will change, your margin will change, and overall profit we calculate mark to market basis. Why all those things are required? If both buy price, sell price I know in advance, why all those circus? I don't know. Fine. I think anyway, let me just explain the way whatever I have to explain. I think I thought basics could be expected that you would know it. In futures, you enter into an agreement to buy or you enter into an agreement to sell. For example, you enter into an agreement to buy. That's what I called as long position. And when I enter into agreement to buy, if I want to do close out my position, then I'm going to do square off. And how I am going to do? I'm going to do agreement to sell. So agreement to buy and agreement to sell, both will be squared off. And agreement to buy, that price is known in advance when I transact. But the agreement to sell, at what price I exit, what price I close out, will be known only at the time of exit. Till then, it will not be known. In this example, I'm future selling at 1950. I'm selling at 1950, that is fixed, selling price. But to do square off, I need one buy price. And that buy price is not known. And it is not 1908. It is not 1800, it is not 1950. It is the price prevailing at the time of exit, which is not known. Which is not known. So we have to assume a number and solve the problem. And one question arises then. If you have to assume a number means, don't you think overall our profit is uncertain? No. We are going to prove. Even the number I don't know, I'm going to assume now. For the purpose of square off, I'll prove it. Overall profit will still be known in advance. That is the arbitrage opportunity which you are talking about. Okay, so we have to make an assumption. Let's say if the price is 2000, I'll tell you how the number is going to be there, and I'll assume one more number and prove same profit will come. I repeat, in future transaction, if settlement is on delivery basis, your sell price is fixed, you execute at that sell price. That's it. If it is forward buy, future buy, your buy price is fixed, you execute at that price. Settlement on delivery basis. But settlement on net basis means you need another number for square off. You need another number for cancellation purpose, which is known only at the time of exit. In this case, I need a future buy price, which is known only on the time of exit. I'm exiting after 6 months. So whatever the price prevailing on that day, example 2000, is going to be used for computing overall profit or loss. If you have got any doubt still, please get clarified. And please don't give me this kind of shocks later, because I'm going to build next strategy like speculations over, hedging over, next we do arbitrage. Then these future concept, I'm taking it as a base for calculating interest rate futures, for currency futures. That's why I'm taking so much of time in futures. I think in yesterday class, we hardly did any problem in about 5-6 hours. Everything was focused only on theoretical aspects. I'll wait for 2 minutes. Let's see if you have any still questions on. When you do future market, you take one position only, one price only is fixed. When you do square off, the other price will be depending on that price prevailing on that date, which is not known in advance. Both the prices will not be known in advance. When we're entering into another contract, is it in future? Why the price will be known? The agreement or you're entering into today, in this example, is you are entering into an agreement to sell. That is called as future sell. You sign the agreement today. Agreement to sell. Clear? After 6 months, you have to sell it. You don't sell it. But what do? You enter into one more transaction of agreement to buy on the same day. So agreement to sell, which is going to be expired at the end of 6th month, and agreement to buy is going to be expired at the end of 6th month. So one agreement to buy, one agreement to sell, future sell earlier, future buy now. That is after 6 months, both will be set off, and thereby difference of cash will come to you. The contract will have either a sale price or a buy price, depending on what contract you enter into. The contract will have a price, contract will have an expiry date. So when I fix it for a price, today I lock a price. When I say I enter into future sell, I'm locking my sell price at 1950. No matter what happens, I know I'm going to sell it at 1950. At what price I have to buy, that depends only on that day. And actually, I don't buy, I don't sell, I do it on square off basis. I do it on net basis. For any transaction, for any trading, you need two price to compute profit. One is sell price, other is buy price. In future agri market also, in spot market also, one of them is known, the other is not known. Now, this is arbitrage strategy where we are doing, even though we don't know the number, ultimately we will prove we get the profit, same profit. Even though we don't know the price at which we are going to square off, even though the price is uncertain, even then we will prove in this example the profit is going to be same. That is what is arbitrage opportunity. Any doubt still? Futures means today if I take a position, I take a position on either on buy or on sell. Only one price is known. The other price is not known. The other price is known only at the time of exit, closing out on square off. And other will be a opposite price. So today if I enter into future buy price and on square off I need a future sell price prevailing on that day. Future sell price prevailing on that date. So my buy price and sell price both will get set off and net amount comes to you on hand. What is square off? So I don't know. What is square off means I have to ask myself, who am I? At this point in time, I have to explain square off after so many classes. Again, this is where I get really heart attacks. What we were discussing whole of yesterday then, if we don't know what is square off. I have to start from beginning again. Okay, I'll do it then. If this is the speed at which we go and this is the kind of explanation I do and this is the kind of learning you have, I don't know whether I've got a wrong student or you have got a wrong teacher. One of them is definitely wrong. My explanation is too bad or your understanding is too bad. One of them must be true. Let's take our convenient answers for ourselves. What is square off? Starting from the basics. Forward contracts. Forward contract means normally you enter into a contract where you fix a price and the date on which you are going to settle. That's called as forward contract. I agree to buy 10 kgs of rice after 3 months at 30 rupees. That is forward contract. And on that date, by paying that money, that is after 3 months, I get the rice. That is forward contract. Future contract is also forward contract. But future contract are having some special features because forward contracts are not traded in the stock market. Forward contracts are between two parties. It has the same effect. Future also is a forward contract, but future are bound by some extra features. Extra features are square off, mark to market, daily settlement, margin money, and so on. That is, future is also a forward market, forward contract, but transacted in the market through stock brokers in the stock market, in stock exchanges. So when I say I enter into future buy, which means I'm entering into a forward contract to buy and another person would have entered into forward contract to sell. And now when the date of settlement comes, I can do settlement on delivery basis. Settlement on delivery basis means whatever the price I've agreed, at that price, you make the payment. I mean, if it was agreement to buy, you make the payment, you get the delivery of the shares. Things are clear. But most popular mode of mechanism is settlement on net basis. Settlement on net basis because, for example, if you agree to buy the shares of Infosys at 1000 rupees and on settlement day in the market, if it is 1200 rupees, what do? Using this agreement, you pay 1000 rupee, get one share, and go to the market where the market people are having Infosys share price at 1200, sell your share at 1200, you get a profit of 200 rupees. So instead of doing buying and selling, why don't we settle on net basis plus 200 rupees? You receive only 200, your objective is achieved. How it is achieved? Through a mechanism of settlement on net basis. And how settlement on net basis works? You have to cancel the previous agreement you have entered into. The one agreement what you have cancelled is going to be given effect with the help of not mere cancellation. It is done such a way that the effect is cancellation. The impact is cancellation. How it is done? By entering into one opposite contract. So earlier, if you have entered into, for example, on 1st of October, you have entered into contract to buy on 31st December. Then, when 31st December comes, what do? You enter into an agreement to sell on 31st of December. Earlier, you entered into agreement to buy expiring on 31st of December. Now we are on 31st December. Again, I enter into agreement which will expire today itself. Means on 31st December. So agreement to buy expiring on 31st of December. Agreement to sell expiring on 31st of December. Both will set off. In effect, difference in cash will come to my account. This process of entering into an opposite contract for the purpose of cancellation, where the amount is received on net basis, is called as square off. So effectively in future market, when you take a position now and you will have an expiry date, an expiry date is standard expiry date. So you will take a position now, let's say future buy. Now on expiry date, you are going to do future sell at that price prevailing on that day, because future buy expiring on a particular date and future sell will be expiring on a particular date. So both will be expiring on same date, so they will set off each other. In effect, they are cancelled. That's what is called as square off. You enter into a position, then you square it off. So future buy, then square off will be future sell. Future buy, price known, agreement to buy, and agreement to sell rate known only at the time of square off. Till then you don't know. Difference amount will come to you by way of cash. So in futures, you will know either a buy price or a sell price, meaning you lock a buy price or you lock a sell price. The difference will be, you buy a lock, you lock a buy price and sell price will be known later. You lock a sell price, the buy price will be known later. The difference is what is your profit, speculation profit. That's what long short also is all about. When you sell at one price, let's say 2000, and later you buy at 1950. So 50 rupees profit for you, because you sold today at a higher price and tomorrow you are buying at a lower price. That's what is called as short position. When the price is down, you make profit. So in futures also we do that. In future, I am taking short position, which means today I do future sell and later I do future buy. So if the price has gone down, I make profit. That's my expectation. If price goes up, then future buy price will be high. My sell price is locked, my buy price is unknown, and if market price goes up, my future buy will be high, and I buy at a higher price means I make loss. In short position, price goes up, I make loss. Similarly, in long position in futures means I do future buy today, and at the time of square off, at the time of expiry, I do sell, that is future sell. So future buy now and then future sell, both will set off each other, that's square off. And today it's 2000, and at the time of square off it's 2100. So I'm buying at 2000, selling at 2100. Price is going up, future sell is going up, I make profit. So my expectation of price going up and making profit is called as long position. When the price comes down, it comes down to 1900. I have bought a 2000, I have to sell at 1900, future sell. When the price goes down, future sell also goes down. So I have to sell at a lower price. So I make a loss. So you are expecting price to go up, but it has gone down. That's called as long position, resulting in loss. Expecting the price to go up is called as long position. Expecting the price to come down is called as short position. Any doubt still? Like what is the meaning of share price? What's the meaning of company? What is the meaning of market? What is the meaning of price? Is the screen locked or solution was complete? I'm speaking, right? I hope my voice is audible. Okay. Let's see if we're able to answer this question now. Now, in arbitrage, settlement on delivery basis does not require any assumption, but settlement on net basis requires assumption. On expiry date, I need some number, otherwise I will not prove with the help of square off, because square off needs price on expiry to be settled. If I don't have that price, square off not possible, settlement on net basis cannot be explained. So we need to make an assumption if they are not given in the question. One more question now. I'm making an assumption of price equal to 2000. Tell me, price equal to 2000, is it spot price market? I mean, spot price or future price? I'm making an assumption of 2000. I'm making an assumption price after 6 months is 2000. Is it as assumption of future price or is it an assumption of spot price? I'm making an assumption on expiry dates. Okay. Again, you have to work on your basics. I think you're not revising. On expiry date, if nothing specified, on expiry date, spot price is equal to future price. Because on expiry date, spot price is for immediate delivery. Even the future price is for immediate delivery because that day only contract is expiring. So on the expiry date, I explained you with a lot of examples also. Today's tomorrow's, tomorrow's today. On any given day in your life, you will have a difference between your future, your dreams and your present. As the time progresses, the gap will reduce. One triangle kind of line I have shown. Even if the spot price remains same, as the time progresses, the future price will reduce because difference between future price and spot price should represent time value of money. As the time progresses, the time remaining to maturity will reduce. So time gap, the value gap also will reduce. On expiry date, the time gap is 0 because spot rate and future rate will be for a same day. That means time value of money is 0, so spot price and future price will coincide. You keep telling, tomorrow exam will come, tomorrow exam will come, tomorrow exam will come. One day it will come. And I also told, you keep telling tomorrow I'll die, tomorrow I'll die. One day will come where your future meets your present. That's called an expiry date. On expiry dates, the spot price and the future price will coincide unless otherwise specified. Why unless otherwise specified? Because even till the last second, the price can fluctuate practically. But for solving exam problems, unless otherwise specified, on expiry date, after 6 months, on expiry date, this number, whatever you assume, is spot price equal to future price. On any given day, there will be a difference. Spot price different, future price different. Because difference will represent time value of money. But on the expiry date, both are equal generally, for exam purpose, theoretically at least. Okay. So now your future sell at 1950. Now if you have to do square off, you have to do future buy opposite at 2000. So do you think you get a profit or loss? You did future sell earlier at 1950. Now you do future buy at 2000. Because you're buying at a higher price, you're going to get a loss of 50 rupees. You're selling at a higher price. You're buying at a higher price. You're sold earlier, future sell. Now square off means you do future buy. You're buying at a higher price. You got a loss. And in spot market, you bought earlier. Now you are going to sell. You make a profit. We are not executing the contract. So future market closed out in future market separately. Spot market closed in spot market separately. No connection between future and spot. Future market closed in the future market. Spot market is closed in the spot market. The inter-segment transaction is not there. We buy in spot, we sell in future. Not possible here. Possible in settlement to delivery basis, but not possible in net basis. Net basis, future market, square off in future. Spot market, close out in spot market. And money market, you repay, you will have interest expense. So loss of 50, profit of 200, interest expense of 108, net profit will come to 42 rupees. So even though this price is unknown, we know this profit at the beginning itself, and that is the nature of arbitrage profit. Whatever happens in the market, we know the profit should be so much. That's where the arbitrage opportunity exists. That's the arbitrage opportunity we have identified. Whether market price moves up or market price moves down, we should make so much of profits. We should know in advance. That's why this is not so realistic practically, because people will find out very easily and the arbitrage opportunity will be taken away very fast. But examination, we need to know the process. We can prove the same by taking a lower number also. Basically, any number you can take, our profit is known. Any number you can take. You should not get a loss in arbitrage. You should know, because at the beginning only, we have identified an opportunity for making a profit of 42 rupees. That should be your profit. Not more, not less. Subject to charges, of course. Even when the price is less, we should get the same answer. So whatever happens to market price on expiry, it should be irrelevant. Our profit should be certain. Our profit is not subject to fluctuations. Our profit is riskless profit. That is arbitrage. And you know, in market don't give you such easy riskless profits. That's why practically it's not relevant, but examination point of view they can ask. Okay, if it is 1700, no problem. You bought in spot market 1800. Now you sell the shares at 1700. You make a loss of 100. 1950 you sold, now you are going to do buy for square off, opposite transaction, square off. You buy at 1700, you buy at a lower price, you get a profit, you pay interest 108. So profit of 250, loss of 100, interest expense of 108, net amount you get 42 rupees. You see, when the market price is high or market price is less. So which number you assume here does not matter. This is assumed. These two are assumed. Which number you assume does not matter. Whichever may be the case, you should know the profit. So in examination, if you want to prove it on settlement on net basis, you need to assume a price on expiry for the purpose of settlement. This assumption not required for settlement on delivery basis. But in some problem, you know what happens? Institute only will give you the question and say, what is the profit or loss? Assume on expiry, either it is 2000 or it is 1700. When they give you like that, you have to do settlement on net basis. You can follow this tabular format. So these two numbers, prices on expiry, should be given or assumed for settlement on net basis, for proving through settlement on net basis, for settlement on net basis, if you want to prove it. Some question I've seen where they'll give you like this. Okay, please write down. Let me know still if you have any doubt. Okay, hope you got it. Is it done? Any other doubts? Okay, hope it is done. Let's also understand one more thing here in this problem. They have not asked, but for our reference. If the future price is 1900 instead of 1950. They have given the problem 1950 is the price. Suppose it is not 1950. If it is 1900, then how are we going to calculate? First step, compute the fair value. Spot price, I think we already calculated, no? That 1908, we know the number already, 1908, same process. Now, the future price is 1900. What do you think now? The future price is 1900, value is 1908. Price is 1900. So can we say it is underpriced or overpriced? Price 1900, lower than value. Price is less. So it is underpriced. Underpriced. Now underpriced means what is the transaction we should start with in futures? Underpriced is always good to buy. So in future we need to buy. So future buy means long position in future. In future buy means in spot we do opposites, which is spot sell. Whatever transactions you do in future, opposite in spots. So this spot what you're doing is opposite transaction of future. Opposite of futures. And if you're selling, you get the money that is going to be deposited in the market. So once you sell, you're going to do deposit. So let's understand both the cases, settlement on delivery basis as well as settlement on net basis. Please write down till there. Okay. Let's do the transaction now. Same format. What transaction you do in market, that is in future market, spot market, money market. Transaction you do today, we just discussed. Future underprice, so future buy at 1900 actual price. Buy means long position. In spot market, future sell, sell, spot sell. And in money market, the money is going to be deposited. And what transaction is going to be there on expiry date? The future contract what you have entered will be executed. Will be executed. Because settlement on delivery basis. The contract you enter into will be executed. Now spot sell, now you are going to do spot buy. Whatever the contract you have entered into, that will be purchased now at 1900. Borrowing matures at 1908. Net cash 8 rupees. I told you can do this on profit base also. So 1800 you sell, you buy 1900. So what is going to be your profit or loss? Your loss I think is 100. and deposit interest is going to be 108 because you deposit. So 8 rupee will give you profit. Ultimately, it's the same thing. So either you can do net amount on cash basis, or you can do it on the cash flow basis or profit basis. Ultimate surplus is 8 rupees. Let's also do settlement on net basis to prove the same answer is there. And what is this 8 rupee profit? Exact difference between the price and value we were doing the comparison earlier. That 8 rupee difference is what is your surplus arbitrage profit. Settlement by delivery basis does not require square off because contracts are not cancelled. We don't require to make any assumptions. Market price does not matter, not relevant. See if you have any doubts. Okay. Settlement on net basis now. Settlement on net basis. Same transaction today will be remaining same, does not matter. Now transactions on expiry will be settled in the respective markets. And if you want to prove it on settlement on net basis, then it has to be explained through assumptions. We need assumption for square off purpose. We need square off means price prevailing on expiry date. Let's make an assumption. The same number we assumed earlier. Price is 2000, one higher price. Price is 1700, one lower price. So square off. So in future buy, earlier you purchased, future buy, square off means future sell. So you make a profit of 100 rupees. In spot market, you sold at 1800. Now you'll buy at this price 2000. Since you're buying at a higher price, you'll make a loss. Interest income 108, net amount you get 8 rupees profit. Similarly, you try for this. If the price is equal to 1700, see, you are able to get the same number 8 rupee. You write down this and you try that. Okay, if you have tried, look at this. You buy at 1700 earlier. Now you sell at 1700, loss of 200. You sold at 1800. Now you buy at 1700, profit of 100. Deposit earlier. I mean, in interest income, anyway, you get 108. So net amount 8 rupees. That's what is difference between price and value. Arbitrage transactions is a concept when the market is not fairly priced. You can take the advantage by selling in one market at a higher price, buying in one market at a lower price. Which are those two markets? Spot market, future markets. And whatever happens in the market, your profit should remain same. That is arbitrage profit, certain profit, riskless profit, known profit. If you explain through settlement by delivery basis, then whatever the contract you entered earlier will be executed as agreed. No need for any assumptions. If you want to show it the settlement on net basis, then you need a price for the purpose of square off on expiry. You can assume one lower price, you can assume one higher price, and you can make sure that under both the cases you get the same profit, and these profits were same as settlement on delivery basis. Overall profit does not change. Mode of operations only will change. But settlement on net basis requires an assumption, and we make a proof that whether market price is up or market price down, overall profit still, what was our earlier discussion, same number will be obtained. Hence, we prove that market price movement does not impact our profit, our riskless profit, our guaranteed profit. Okay, so I hope you got this one. So in arbitrage, we always assume there is a profit. Not we assume, we are proving. Only if there is a difference, we can make profit. Like here, the price and values are different, so we can make a profit of 8 rupees through these transactions. Arbitrage opportunity, only the difference is there, we make a profit. If you do wrong transactions, you make loss. That is your stupidity. That's not, we can say, profit or loss. Arbitrage exist means there is a profit opportunity exist. You make a proper transactions, learn it, execute it. So arbitrage opportunity means there is an opportunity for riskless profit, certain profit, if you perform these operations. Okay, I hope you got it. Let's move on.